start with the, we won't waste much time. Let's start with the business for today.
Yeah,
Yes.
yeah.
Yeah, I can hear you.
Concentrate on the capital allowance.
Okay.
Since there's an issue there, double deduction has been taking place.
In the solution we have done,
The calculation we have done,
oh, really?
60% was taken as this thing, as a motor vehicle. And then after we have deducted a distance, we still go back again to deduct it again.
Question 3.
Concentrate.
Is it on the one on is it APK Limited?
Yeah, APK limited.
Okay. So your
The
concern is,
solution there,
so we've deducted what value 2 times?
60% on the disposal,
Okay. The 60,000.
and the 60,000.
Yeah, this value.
Yes,
We have deducted it 2 times.
2 times.
Oh, really?
Yes.
Can somebody also confirm that?
No, let me come. I think it is once, but just that
It's not
in but
it's
just
not
that
once.
in yeah uh, it in determining the risk and improvement, that the written down value of that pool, you need to factor in the 60,000, take it out, before you get the written down value. Then you now look for your 5%. So when you get your 5%, then you will now bring it in addition, and also bring the same disposal there again, 60,000. So it's not twice. You only bring the 60,000 for you to be able to get your written down value, so that you can have a 5% restriction. So once you are able to get the amount of repairs and then the 5% restriction, whatever value you get there becomes the addition that you will add to the 2023 year of assessment to compute your capital allowance. So in determining your capital allowance over there, you would have to factor the disposal of 60.
Thank you, Tinama. Thank you very much, Senior Nathaniel. John the Baptist,
Yes, sir.
do you follow what our senior is saying? You see,
I'm
it
not
is,
seeing it that way because
yeah. Mhm.
we have the, the machine was disposed in 2023,
Okay.
and we have determined the repairs and maintenance out of that.
Okay.
And that machine has also taken, the disposal have taken place effect on that day. Then why are we now adding it again when we now get the excess value for the machine, and we are going back to add it back to deduct it again?
Oh,
That was my argument on that.
okay. I get to your point, but I hope you can see my screen.
Yeah, I can see your screen now.
Yeah, this is the working that I did. You see, the rule is that
Yes.
repairs and improvements will be subject to 5% of the written down value of the pool at the end of the year. I hope you know that rule.
Yeah. Yes,
So,
that rule is
yeah.
understand.
So it means that before you calculate if there is a repairs and improvement cost, for capital allowance purpose, you must subject that repairs and improvement to the 5% of the written down value of the pool rule. Now, this is what you do. This is the workings I did. So
Yeah.
you go through the process that year, the year 2023. What happens to the additions and disposal of assets in 2023? So you do your working. This one is a working. This is not the main capital allowance. This one is a working. So this is where you go through the process. The written down value is 157,452. Then that 2023 addition was 70,000, disposal 60,000. Then we can know our depreciation base. We calculate our capital allowance 30%. No, this is the written down value at the end. This was done without factoring in the repairs and improvements. So we want to know the repairs and improvement. I think the cost is 40,000. So
Yes, the cost is 40,000.
yeah, so out of the 40,000, how much should be expensed and how much should be capitalized? So you have to go through the process for this one. This is a working. This is not the actual capital allowance. So this one is just a working that I did here. This one is a working. So first you go through the process, you consider all the things that happen. So there was a disposal in 2023. You consider all of them to know the written down value at the end. This is where you find the 5% of. So the 5% of the 117,216 will give you 5,861. It means that this is the amount that can be expensed. The excess is 34,139. This amount will be capitalized. This amount will be capitalized. So this is not the calculation of capital allowance. No. This calculation, we want to know the repairs and improvement, how much will be expensed and how much will be capitalized. This is the main calculation of the capital allowance. So you are saying that we've deducted the 60,000 here again. Is that not your concern?
Yeah, my concern is the main capital allowance.
Yeah, so the main capital allowance, we only deduct the 60,000 once, just once, not two times. This one is a working.
Here on the repairs and maintenance side of this one.
Come again, sir.
Okay, it's okay now.
Are you okay now?
It's okay. I'm okay.
Are you sure, senior?
Yeah, I'm okay. I'm okay.
All right, okay. Okay, then our senior is okay. We thank God. Then let's move on with what we have to do for today. What information it is. All right, so today, any other clarification before we move on with international taxation? All right, so international taxation is 10 marks. The weighing is 10 marks. So no matter what, you will see 10-mark questions on international taxation. All right, so I have some questions here that we use to revise what we have learned on international taxation. All right, so let's start with the first question. So the first question, I believe you guys have gone through this question already. And today we have to move fast. If not, we will not be able to finish what we have to do for today. We have to move fast. If not, we won't be able to finish what we have to do for today. So the A part of question 1 is Opele Manufacturing Limited, located in Kumasi, and a rental income of what? Of a rental income from Nigeria. The net foreign rental income in for 2021, year of assessments, amounted to 5 million. Therefore, 5,913,000 naira. In the home front, the business and the post-tax profit of 121,875 for the 2021 year of assessment. Now, there's a double taxation agreement between Ghana and Nigeria. Exchange rate 1 CD is equal to 65.7 naira. Nigeria withholding tax rate is 10%. Ghana has adopted 2 methods in eliminating double taxation deduction. So Ghana has adopted 2 methods. So we have the credit method, and we have the deduction method. So in Ghana, this is the 2 methods that we use. Whether the tax that you have paid to the foreign country will be given to you as a tax credit, or the tax that you have paid will be given to you as a deduction from your income before you pay tax. So the requirement is, the first one, you have to state 6 benefits that Ghana and Nigeria stand to gain from this arrangement. So the first one, they're just asking you the benefit of double taxation agreement. So 2 countries are Ghana and Nigeria. They have the double taxation agreement. So what are the benefits that Ghana and Nigeria stands to gain from the double taxation agreement? Then the second one, you have to compute tax payable to GRE using the 2 methods. So using the 2 methods. See, this one, the examiner did not give you the method. So you have to know what are the two methods that Ghana have in eliminating double taxation. So we have the credit method and we have the deduction method. Now, so let's solve the question. Let's solve the question. Now let's answer the first question. So what are some of the benefits of double taxation agreement? What are some of the benefits of double taxation agreement? This is for 3 marks. So these theory questions, they are the ones that will make you to cross your 50 mark in order to pass the paper. So benefit of double taxation, it eliminates or it prevents international tax avoidance and tax evasion. It promotes foreign investment. It promotes foreign direct investment. If investors know that, okay, the country I'm coming from, that country have a double taxation agreement between Ghana, they'll be willing to what? To come and invest in Ghana because they know any tax they pay in Ghana in their country, that tax may be given to them as a credit or that tax may be given to them as a deduction. So they'll be willing to come and invest. It creates fiscal certainty for investors in the affected countries. So try and know the importance or the benefit of double taxation agreement. Now, we have to compute the tax payable using the two methods. So the two methods, we are using the credit method. Then we are using the deduction method. So, if you're a tax resident in Ghana, your worldwide income will be subject to tax in Ghana. Your global income will be subject to tax in Ghana. So this question, what's the name of the company itself? What's the name of the company?
Pele
Opele Manufacturing Limited. Okay, it's located in Kumasi. So this will give you a hint of the tax rate. Kumasi tax will be at 18.75%. All right. Now, the business income from Ghana. How much is the business income from Ghana? Business income from Ghana is how much?
121,875.
Is that before tax or that's after tax?
Post-tax.
Post
That's
tax.
after.
It means tax has been deducted.
Yes.
But when we are computing the tax payable, you have to include the gross amount. So how do we get the gross amount? How do we get a gross amount? The tax rate is 18.75%. So you can just do 100 over 81.25 times 121,875. The tax rate is 18.75%. So that should tell you that tax amount, the tax amount of 18.75% was deducted before they arrive at the net profit after tax of 121,875. So you just do 100 over If you take 18.75% out of 100, what will you get? I think you get 81.25. That will give you 81.25. So 100 divided by 81.25 multiplied by the post-tax profit. That will give you 150,000 Ghana cedis. Now, the income from Nigeria, the Nigeria income, rent income from Nigeria. Now, the rent income, is it also after tax or is before tax, or the tax has already been taken out?
Yeah, net foreign income.
It's net foreign income. How much is it? Where is it? There is
59.
net foreign income. All right. So it means we have to convert. It means that the tax of 10% was deducted. The net is the 5,913,000. And this one too, we have to convert it to Ghana cedis. The exchange rate is 1 Ghana cedis is equal to 65.7 naira. So are we going to multiply or we are going to divide?
Divide.
We are going to divide. So when you divide in Ghanaian cedis to be 5,913,000 divided by 65.7. A tax of 10% has already been taken out. So just multiply this one by 100 over 90. Or whatever you get, divide everything by 0.9. It will still give you the same value. It will still give you the same value. So when you do that, how much will be the gross rental income in Ghanaian cedi? How much will you get?
100,000.
You get 100,000, right? So the gross rental income will give you 100,000. So 5,913 divided by 65.7 multiplied by 100 over 90. That will give you 100,000 Ghana cedis. So these are the two sources of income for Opeli Manufacturing Company Limited located in Kumasi. So the global income will be how much? That will give you 250,000. Now we are using the two methods, credit method and deduction method. And you know under the credit method, the tax paid in the foreign country will be given to you as a tax credit. It means that you include the gross income, the gross foreign income, when you are computing the tax payable for the period. Now, after you have gotten the tax payable, you now have to deduct the foreign tax paid. You now have to deduct the foreign tax paid. Now, the deduction method is that the tax paid in the foreign country will be given to you as a deduction from your income before you pay tax. It will be given to you as a deduction from your income before you pay tax. So let's deduct the foreign tax paid. So the foreign tax, the rate is 10%, is that not it? So that'll be 10% by 100,000. So we are under the deduction method, that'll give you 10,000. So we'll get our chargeable income. This will give you 240,000. So this is our chargeable income. Now we've gotten our chargeable income. So now let's compute our tax. So tax at 18.75%. 18.75%. So 18.75% of 250,000. How much will you get? You get 46,875. This will give you 45,000. To give you 45,000. Now we less the tax, the foreign tax credit from Nigeria, the foreign tax credit. So that will still give you 10,000. And that deduction, there will not be any foreign tax credit. So net tax payable to GRA. So net tax payable to GRA will be, this will give you 36,875, and this will give you the 45,000. Now, under the two methods, which one of them do you think will be favorable to the government? And which one do you think will be favorable to the individual taxpayer? So if the government wants to generate more, if the government wants to generate more revenue through taxation, which method should they go for? If the government wants to generate more revenue through taxation, which method should they go for? After computing, you have to explain. That's one problem examiners always talk about. That candidates can compute, but they cannot explain. Advanced taxation is all about giving advice. So every computation you have made, you must be able to what? Explain your calculation. You should be able to explain your calculation. You should be able to advise both the taxpayer and the government. So this question, after computing, you should be able to explain. You should be able to explain. Now, under the credit method, net tax payable to GRA is 36,875 Ghana cedis. Under the deduction method is 45,000 Ghana cedis. So if the government want to generate more revenue for development, then they should go with what? The deduction method. Or the deduction method will give them 45,000 Ghana cedis through taxation. But to the taxpayer, the taxpayer will prefer the credit method. The taxpayer will prefer the credit method because there will be some form of tax savings over there. Because under the credit method, the taxpayer will be paying 36,875. So the taxpayer will be making some savings will be made. I think that will be 45,000 minus 36,875. That will give you 8,125. So you see that the taxpayer will prefer the credit method to the deduction method. That's the reason why under section 112 of Act 896, this is the Income Tax Act, section 112. The taxpayer may apply to the Commissioner General to relinquish the right of the credit method to prefer the deduction method. So if the taxpayer write to the Commissioner General now, okay, fine. Maybe I want to help the state to generate more revenue. So my right under section 112, which will be entitled to the tax credit method, no, apply the deduction method to me. So in that case, the tax paid in a foreign country will not be given as what? As a tax credit. It will be given as a deduction. So unless the taxpayer apply to the Commissioner General that I want to relinquish my right, then the Commissioner General can use the deduction method instead of the credit method, because the deduction method will what? Will give the state more revenue for development, and it will favor the taxpayer. So unless the person apply, Mr. Nyamiche, your hand is up.
Sir, please.
Good evening. You are welcome.
Thank you. Good evening. Please, seriously, I did not get the first three transactions. Why I'm seeing those fractions? So please, if you can go over for me to get. Thank you.
All right. You are welcome. That's punishment for joining late. But no problem.
Yes.
No problem. We are together. So you see, I believe you have the question with you. So
yes, I have the question.
We are doing question 1 under international taxation. So the question is that the company earns net foreign rental income of 5,913,000 naira. It means that the tax has already been deducted. The tax rate given to us is 10%. It's 10%. So it means the tax of 10% have already been deducted before the company receives the net rental income of this amount. Now, when you are computing the tax payable in Ghana, which is the resident country of the taxpayer, we compute your tax based on your gross rental income. Your gross income, not the net. Because we have to include your gross income before we know your total accessible income. So in that case, if you are computing the rental income from Nigeria, you have to gross up this amount. You have to gross it up. So in grossing it up, they give us the exchange rate. 1 Ghana cedi is equal to 65 naira 70 pesos. So in grossing it up, it means that you have to first of all convert this value to Ghanaian cedis. So in conversion, you divide it. It's naira, so you divide it. When you divide it, now you have to gross that value. So in grossing, you can just do 100 divided by 90, multiply by whatever you get. Or if you gross it out, whatever value you get will be equivalent to 90%. Because 10% tax has been deducted. So whatever value you get will be equivalent to 90%. Just divide whatever value you get divided by 90%. That will give you the gross income, the gross rental income. So that's what I did here. So what I did was the rental income from Nigeria, I say 5,913,000 Ghana divided by the exchange rate, 65.7, multiplied by 100 over 90. That will give you 100,000. That will give you 100,000. Then the business income in Ghana, the business income that has been derived in Ghana is post-tax profit of 121,875. This is after tax, post-tax, after tax. So gross it up. The company is located in Kumasi. This one, the examiner will not give you the rate. You have to know the rate. The company is located in Kumasi and it's a manufacturing company. So the tax rate will be 18.75%. It means that the gross income, a tax of 18.75 have been deducted before they earn the post-tax profit of 121,875. So in grossing it up, you can just do 100 over, when you deduct 18.75 out of 100, you get 81.25. Multiply by this value, that will give you the gross amount. Or this amount is equivalent to 81.25%. So just divide this value by 0.8125. It will still give you the 150,000. My sister, I believe you are fine.
Yes.
So I can move on now in peace.
Yes, you can move on. Yeah.
All right, okay. So
Thank
I'm
you.
saying that if the taxpayer under section 112 of Act 896, a taxpayer may write to the Commissioner General to relinquish its right under the double taxation agreement. So normally, if the taxpayer writes to the Commissioner General, it means that the credit method will not be used. So we use the deduction method. Because if you use the deduction method, the tax payable will be higher than what if you use the credit method. Unless the taxpayer writes to the Commissioner General before you can use the deduction method. All right, so we are done with this question. Let's move on to the next question. The next question is a killer question. There are a lot of things in there. Okay, the B part. Let's answer the B. Double taxation can adversely affect direct and portfolio investment as well, encouraging aggressive tax planning. So economic double taxation has several negative effects which needs to be eliminated. Briefly explain economic double taxation and discuss how it can be eliminated. So you know that the double taxation, we have two forms. We have juridical double taxation and economic double taxation. Economic double taxation is taxing the same income in the hands of two different individuals. The same income is taxed in the hands of two different individuals. So the most common one is taxation of dividend, or taxation of a corporate income, corporate profit at the corporate level, which will be corporate income tax. Then when the same income is distributed to the shareholders again, it will be taxed in their hands as dividend. Now, how can you eliminate economic double taxation? That's what the question is telling you. So you explain economic double taxation and how it can be eliminated. Now, in eliminating economic double taxation, there's something we call participating exemption. Participation exemption. So under the participation exemption, it will be clearly stated that certain income, so we normally talk about the share capital. So the agreement will be that if the shareholder is able to have certain percentage of the company's shares, then dividend in the hands of the shareholders will not be taxed. That's what we call the participating exemption. So in the agreement or under the participating regime, it will be clearly stated that if the shareholder is able to hold certain portion, certain percentage of the share capital of the company, then dividend paid to that company will be exempted from what? From the 8% withholding tax. So in Ghana, we have two main forms. So one is that dividend paid to a resident company. You have to remember this rule, this principle. Dividend paid to a resident company by another resident company. This is I will not be writing. If I want to write, I will not move fast. So I'll just explain. So you write your own note. Dividend paid to a resident company by another resident company, whereby the company receiving the dividend controls either directly or indirectly at least 25% voting power of the company paying the dividend. The dividend will be what? Will be exempted from the withholding tax. So that's one way of eliminating economic double taxation. Dividend paid by a resident company to another resident company, whereby the company receiving the dividend controls at least 25% of the voting power of the company paying the dividend. Then that dividend will be exempted from withholding tax. So if you hold 26% in a company, if you hold 26%, any dividend you receive will be exempted from withholding tax. If you hold 24%, every dividend you receive will be subject to 8% withholding tax. So companies are advised to at least hold more than 25% of the voting power in a company. Then every dividend you receive will not be taxed. The second one is the Free Zone Act. So Section 27, subsection 3 of the Free Zone Act 504. So we know free zone companies, dividend that they pay to the shareholders are exempt from withholding tax. Dividends that shareholders of free zone companies receive is not taxed. The 8% withholding tax is not applicable. So in Ghana, those are the two ways that you can use to eliminate economic double taxation. Any question? Can I move on? All right. Let's go to question 2. I'm saying that question 2 is a killer question. A lot of withholding taxes are in question 2. So the question 2, if you don't know the principle of withholding taxes, it will whatever you do will be over the bar. So you need to know the principle of withholding taxes. Very, very important. Now, Mr. Kofi Kwarteng is a well-known amputee. This will tell you directly that whatever accessible income this man will have, there will be a relief of 25%. Quarter of the accessible income of what? Of a disabled what will be exempted from withholding tax. So whatever accessible income this man will make, 25% of it will not be taxed. So there will be a relief of up to 25%. Now, he actively engages in a diverse portfolio of investments in both Ghana and other foreign countries. He firmly believes in the value of investing, directing all his earnings towards various available investment opportunities. Despite my suggestion, Charlie, is your suggestion, that the man should resign from his employment in Ghana, which currently fetches him 60,000 annually, due to his substantive worth, he remains steadfast in his decision. During our conversation, he provided the following information regarding his investment for the 2022 year of assessment. So this man in law is into what? Employment. And the employment, his annual income, his annual salary is what? Is 60,000. So, he's an individual. So we tax him based on his global income. And when you are going to determine his accessible income will be determined from employment separately, from investment separately, and if he engage in any form of business, from business to what? Separately. Now, these are the information the man provided regarding his 2022 year of assessment and his investment. So it means the man is into a lot of investment. So what we do is, as I'm reading the question, we'll be explaining the treatment, how the item will be treated. So that immediately I'm done reading, we start solving. Rental, even if you don't solve, if I explain, you can go and solve. Rental income, that is on residential property to Madame Josephine in Togo. The net amount he received was 96,000 Ghana cedis. 20% tax was what? Was deducted. So it means in determining his assessable income, this is a foreign income. So we have to calculate this, we have to gross up this amount and add it to his income. We have to gross it up. Just divide it by what? 0.8, you get a gross. Rental income, that is on commercial property to Osman Limited, Ghana. What the tax rate on this one? This rental income, what should be the tax rate? Or how are we going to treat it? Can somebody hear me?
The rental income is 8%.
Yeah, 8% residential, is that not it?
Yes.
But this one is commercial. What is it?
15%.
15%. All right.
Yeah.
So, okay. So how should the treatment be? Are we going to add it to his income?
It is final.
All right. So it's final. So it means what?
We'll not add it.
All right. It's final. So this is final. So even though this is the net amount he received, it means that the withholding tax of 15% has already been deducted. So in this case, this is a final withholding tax. So you don't add it when you are determining the accessible income of the taxpayer. You don't add it. It's final. It is only if the tax is on account that you add that income. When you are done, the tax paid or the tax withheld will be given as a tax credit. But in that case, you have to even gross the amount so that you put the gross amount when you are determining the accessible income of the taxpayer. Dividend, that's he holds 10% in Animal Limited. He received 92%. Dividend, what's the rate?
8%.
Final or on account?
Final.
Final.
So don't add this one. He has already paid the 8% tax on the dividend already. So let him enjoy this amount in peace. So the tax is final. So you don't add the dividend. Now, dividend holding 30% in UK resident company. 7.5% tax was deducted in UK. He received 185,000 Ghana cedis. So this one will be the treatment. This one, the company is not a resident company. This is a foreign income. So we don't subject foreign income to that withholding tax rate. We don't do that, no. Because that income is not from Ghana. If the investment income have a resident in Ghana, have a source in Ghana, then you apply your withholding tax rate and go, whether it is final or it is on account. But so far as it's a foreign income, you have to add it. You have to add it. So this amount, 7.5% tax was deducted. So we are going to gross it up and add it to his income. Interest income from Rashid manufacturing business. 98,000 Ghana cedis was received. This is net. So what the withholding tax rates on interest income?
15.
Hey, this is Anyamichi.
8%.
Remove that 15%. I have the shaded down there. Revise them.
8.
It's 8%. Final or on account? Final or on account?
This is on account.
So are we going to add this amount?
Yes.
You are going to add it, right?
Yes.
Okay. Mm. I shared some brief summary on withholding tax on dividend and investment on the page. Mm. You see, interest. There are certain form of interest that are not subject to the 8% withholding tax. The first one is interest received by an individual. If you are an individual, you receive interest. That interest will be exempt from tax. If you are a financial institution, you receive interest. That interest will be what? Will be exempted from tax. But if you are an individual, every interest you receive, apart from if you invest in companies into mining or petroleum industries, that one, the withholding tax is 1%. So an individual, you can receive interest from a company, whatever. That's the reason why you as an individual, if you make an investment, you receive interest. They don't tax you on it. So this question, this one is testing you to know whether if you know, this man is an individual. John Ofori is not an individual. Mr. Kofi Kwarteng is an individual. So the interest that he is receiving from the Rashid Manufacturing Company will be exempt from tax. But apart from that, if like the investment is into mining activities or the companies is into mining activities or petroleum activities, the interest will not be exempt from tax. The tax rate will not be 8%, it will be 1%. The 8% is other companies. If you are a company, you make investment, you receive an interest, the 8% will be charged on it. By an individual, you receive interest, the interest will be exempt from tax. So this one will be exempt. So we allow him to enjoy it in peace. Royalty. What the withholding tax on royalty? Royalty is what?
5%.
Come on for there. It's 15% on account. 5% is the royalty to government, to the state. That is the royalty to the state. But withholding tax on royalty, if you receive royalty payment as an individual, you receive a royalty payment. The withholding tax rate is 15%, and it's on account. It's in the summary of down the note. It's in the summary there. Interest income from Quindo manufacturing business. This is Germany. This one is an individual. This interest is not coming from Ghana, so we tax it. The interest is coming from a foreign country, so we tax it. So this one, you gross it up. 8% tax on deducted. So you gross it up, divide it by 0.92. That amount, add it to his income and tax. I think that is the investment. Now, additional information. He makes quarterly contribution of 60,000 donations to what? To Heart Foundation. This is an allowable deduction. So on annually, you just multiply this by 4. That will give you 240,000. So there will be a deduction in respect of the donation, 240,000 annually. Quarterly, he makes 64. He makes 60,000. So just multiply this by 4. On December 30th, 2022, he received a gross interest amounting to 50,000 from his GCB bank account. This will be exempt from tax. Your bank account you have made, your bank account as an individual. When you receive any interest, they don't tax you. It's exempt from tax. He also ran a sole trader business in Ghana, which earned him a net profit after tax. It is net profit after tax from the business. It's a sole trader business, one-man business. So the net profit after tax is 366,293 Ghana cedis. This was after the tax at the graduated individual rate. The graduated rate was computed and deducted. So this income must be added to his income and tax, but it must be the gross. It must be the gross. So we are going to gross it up. Now you learn how you do that. When the tax is deducted using the graduated rate, how do you gross it up? You do that. It's very simple. First of all, use the net income. Use the net income. Calculate the graduated tax rate. use the graduated tax rate and calculate the tax payable on the net. While you are done, the last rate, that's the first step. The second step is use the last rate in your computation. The last rate that will be down there, that's the rate that you are going to use to gross up the tax that you have calculated. So use that rate, gross up the tax you have calculated, add it to the net, then you know the total income. So we will do that calculation. We will do that and add it to his income. He also received his endorsement fee from High Sense Ghana Limited. So 4,000 tax was deducted. Now, endorsement fee. What's the withholding tax rate on endorsement fee? See this question. The examiner did not give you the amount of the endorsement fee. The examiner did not give you. You have to know the endorsement fee. What is the withholding tax? They only gave you the tax that was deducted, 4,000. So if you don't know the withholding tax rate on endorsement fee, you cannot do anything about this particular information. So what's the withholding tax rate for endorsement fee? And you have to know whether even it is final or it is on account. What's the tax rate?
10%.
Come again, senior.
10%.
All right. Endorsement fee is 10%. Is it final or is on account?
Final.
It's final. It's final. It's final. So we don't add the endorsement fee. It's 10% and it's final. So this one, in grossing it up, it tells you that if the tax is 4,000, it means that the total income is 40,000. 10% of 40,000 will give you what? The 4,000. So this one is a final. It's a final tax, so you don't add it. He received interest of 8,000 on his T-bills. Interest on treasury bill is exempted from tax. Interest on T-bills is exempted from what? From tax. Kweku Kwatin, a tax practitioner, was hired to provide tax planning assignment to Kaklu Ghana PLC. So the contract were performed on 13th May 2022 and 18th to 20th October 2022. So 1,500 and 10,500 was received respectively. The contract sums are 1,500 and 10,500 respectively. This is in respect of withholding tax on service. Service is 7.5% on account. Now, there's a rule regarding the withholding tax. The threshold is 2,000 Ghana cedis. So if the payment does not reach the 2,000, you don't charge the withholding tax. But if you believe that, okay, within the same year, you are going to award the same contract to the same service provider or the same supplier, the same contract will be done. And you expect that, okay, the amount will exceed the 2,000. Then you can start deducting the withholding tax from the first payment that you made, even though if the payment does not exceed the threshold. Now, this case is the same tax planning services that is being provided by Kweku Kwatin to Kaklo PSC. So what you do is you just add the two amounts. When you add the two amounts, you get 12,000. That 12,000 will be subject to 7.5% withholding tax on account. So what you do is you add the 12,000 to his income. When you are done, come and grant the 7.5% tax as a tax credit. He is also an agent for PK Insurance Company situated in Ghana. During the year 2022, he received a commission from PK Insurance, which was paid to his UK bank account. The insurance company withheld an amount of 1,000 Ghana cedis on commission paid to what? To Mr. Kofi Kwatin. Now, commission paid to residents or commission paid for insurance services. What is the tax rule on it? What is the tax rule on insurance payment, on commission paid for insurance services?
10%.
10%. Is it final or it's on account?
On account.
Commission is 10% on account. So if 10% tax is equivalent to 1,000 Ghana cedis, that should tell you that the gross amount should be 10,000. So we add the 10,000 to his income. We add the 10,000 to his income. When we are done, we can give the 1,000 that they deducted as a tax credit. Are you guys following the thing, how the thing will be done? Okay. Then he is a chartered accountant. This man alone was the problem. He marks Institute of Chartered Accountant Ghana exam script. During 2022 year, he was present for all the three diets. So he received net amount 7,200 from April, August 76,500, and December 7,200. Now, what is the withholding tax on marking allowance? What's the rate? Marking allowance, what's the rate?
%10 final.
10% final or on account?
Final.
All right, so 10% final. So we don't add this one. We don't add it. The tax that these are net amount. The tax of 10% that will be deducted satisfy the final tax liability of Mr. Kofi Kwarteng. So you don't add it again. Now the requirement. Compute for 14 good marks. I think the 14 marks will be what? Will be what? Will be worthy. But mind you, international taxation is just 10 marks. Just 10 marks. So, but this question is for CITG students. I brought this here for us to solve. It will give us more understanding of international taxation. So for them, that side is 20 marks. So this one is for 14 marks. So I think the 14 mark will be appropriate for this kind of workings. For ICAG, international taxation is 10 marks. So they can just limit it, remove some items and bring this question for 10 marks. So compute the tax payable by Mr. Kofi Kwarteng for 2022 year of assessment. Now B, if Mr. Kofi Kwarteng decides to relinquish his right under section 112 of Act 896, compute the tax payable by Mr. Kofi Kwarteng for 2022 year of assessment. So this is question 2. Mr. Kofi Kwarteng. What is in the chat box? Please, can someone send me the withholding tax document? Oh, it's down there. It's in this note. The rates are down there. Senior, Miss P. If you have the document I'm using, the rates are down there. The rates are down there. So the basis period, can you remind to be writing this one? To also take mark. January 1st, January 2022 to 31 December 2022. The year of assessment is 2022. All right. We have to compute his tax payable. So computation of tax payable. So his income, let's do the employment income. So his annual salary is, how much is the annual salary? 60,000. I believe it's 60,000. Is it 60,000? Okay. Now let's go to the investment income. The investment income, there are lots of investment income. So we have to add the foreign. But first, let's do, but the foreign incomes, all of them are investment income. So what is this document? Somebody is saying he doesn't have the document we are using. I want to forward it to the person. I cannot actually not see it. Okay, it's here. All right, so let's go to the investment income. So the first one is the rental income from Togo. So rental income from Togo. The amount is 96,000. That a tax of what? 20% was deducted. Is that not it?
Yes.
So that will give us, let me just do, that will be 100 over 80, multiplying the 96,000. How much are we getting?
120,000.
120,000. The next one there, I think, is the dividend from UK. I've already explained the thing. Dividend from UK. The amount is, how much is the amount? 185,000.
Yes.
And the tax deducted, what's the rate? 7.5. Is it 7.5?
Yes, please.
So that will be 100 over 92.5 multiplied by 185,000. That will give us how much? 200,000.
200,000.
200,000. All right. The next income there per the question, let's do the foreign one first. The foreign income before we add the Ghanaian investment income. So the next one is the Germany, the interest that he received from Germany. Interest from Germany. The next amount is how much?
82,800.
A tax of 8% was deducted. Is that not it?
Yes.
Yes.
So 100 divided by 92, multiply 82,800. How much are we getting?
90,000.
18,000.
90,000. All right.
89.
Here is the royalty. The royalty we said is on account. Is that what it? So let's add the royalty. The tax deducted from the royalty is what, 15%? Is that what it?
Yes.
Yes.
And the net income is, that'll be 100 over 85, multiplying 66,300. So that'll give us how much?
78,000.
78,000. All right. Do you have any other income? Per the additional information, do you have any other income which is on account that we can add? Do you have any other income in the additional information, which is, we are not adding the final ones and the exempt ones, we are not adding them. So it's the ones on account. That's the one we have to add. The final one, the tax withheld, satisfy the final tax liability of the taxpayer. So we've done, okay, we've done royalty. Okay. The first additional information is donation, which is allowable deduction. This is an exempt income. Okay, we'll do, this is income from business. So we'll come and draw this amount and add. We are doing investment. Endorsement fee is final. We are not adding you. Treasury bill is exempt. We are not adding you. Yes, the consultancy services. 7.5% tax will be deducted, and the total is 12,000. Total is 12,000. So we are going to add that one. So you are adding the 12,000. The tax is not deducted yet, because these are the contract sums. These are not the net amount that he has received. So you add it, then the tax will be given as a credit. Then commission is on account. Commission is on account. 10% was 1,000 tax was deducted. So that means the gross amount is 10,000. So we'll be adding the commission of 10,000. I think that's the last one. The marking is final, so we don't add the marking. Okay. So let's add the services, the consultancy services. So that'll be 1,500 plus 10,500. This will give us 12,000. 12,000. Then the insurance commission. Insurance commission. Insurance commission will be 10,000. I believe we are all okay with the 10,000. The rate is 10% on account. And if 1,000 tax has been withheld, it means the gross amount will be what? Will be 10,000. So 10% of 10,000 will give you your 1,000 Ghana cedis tax withheld. So what's the total investment income? Total investment income will be how much?
A minute. Yeah, 1 minute.
So let's add fast. 120 plus 200 plus 90 plus 78 plus 12 plus 10. 510, right?
Yes.
All right.
Yes, 510.
So investment income is okay to be here 510,000. Now let's move on to the income from business. So this one we were told that he received, amount received is what? 366,293. Is that the amount? Is that the amount received?
Yeah.
Okay. So let me do the working so that we get the gross amount. So anytime the business is a sole trader business, it's a sole trader business. So it means that the tax will be deducted, will be computed using the graduated rate. So anytime they give you the net, you have to find the gross. Now, these are the steps you have to follow in order to get the gross. So the first step is calculate the tax using the graduated rate on the net amount received. So tax on net business income of the amount is 366,293 using the graduated rate. So we know that the first amount, the first 5,880, the rate is nil and there's no amount. The next, by now you should have this one in your head. Even if they don't give it to you, you can use them to solve the question. The next, but they will definitely provide it. The next 1,320, the rate is 5%. This will give you 66. The next, if you know them in your head, you know if you struggle referring to the one given to you. This is the current one we are using, so this is the one they will give you. The next 1,560, the rate is 10%. This is 156. Followed by the next, followed by the next
38,000.
38,000. The rate is 17.5%. This will give you 6,650. The income is big, 366. All right, so followed by the next 192,000. The rate is 25%. This will give you 48,000. Will give you 48,000. I think we can do the remaining now. We can do the remaining. So what will be the remaining? Add all this one out and take it out of 366,293. And this one, the rate is 30%. I'm getting 127
533.
533. By 30%, I'm getting, let's approximate the value to the nearest whole number. Let's approximate the value to the nearest whole number. So 127,533 by 0.3. I'm getting 38.
260.
260. So what the total tax? Plus 48,000 in addition to 6650 plus 156 plus 66. So 93, 132. This is the total tax. Now, this is the first step. Now, the second step, this is step 1. The second step is to now have to come out. You have to gross the tax. The tax you have calculated. This tax is on the net amount. So you have to gross this tax using this rate, using the last rate. So why you use this rate, it means that if the tax is 30, then it means this amount is equivalent to what? 70%. So grossing it up, it will be 100 over 70 multiplied by this amount. That will give you the gross amount. Then we add the step 3 is you add the gross tax amount to the net income. That will give you the actual business income. So step 2 is to gross the tax amount using the last graduated rate. So if you do that, then it will be, this will be 100 over 70 multiplying 93132. How much are we getting?
One 133,045.7.
Okay, so
46.
133,046.
Okay. Yeah.
So this is the tax amount. So the step 3 is to just add the gross tax amount to the net business income. So this will be 366,293 plus 133,046. This will give you how much?
49339.
499,339. So this is the gross business income. So this is 499,339. All right. So let's get the global income. So let's get the global income. So 499,339 plus 510,000 plus the total business income is 60,000. So this is 1,069,000 Ghana cedi. Now let's move on to the reliefs. The reliefs.
339.
How about guessing here?
339. 1,069,339.
It's 339.
Yes, sir.
Okay, all right. Thank you very much, Senior. So it's 339.
Oh, it's 1,009,339.
Yes. Yes. 1,009.
1,009,339.
No, I'm not sure.
No.
That's it. It's
It's
510,000 plus
510,000 plus 499,339
499,339.
is
1,009.
1,009.
plus
339.
plus 60,000.
60,000.
There's a 60,000 here. The annual, the salary from
Oh, okay.
employment.
Okay.
Plus
All right.
60,000. Yes. All right. So
All right.
let's take the relief out. So we deduct the reliefs. So the first one is into employment. So the 5% is compulsory. 5.5 by 60,000. That will give you how much? 3,300. Now, he is making donation to Heart Foundation. So this will be 60,000 quarterly by 4, 240,000. The disability is disabled. The disability relief, that will be 25% by 1069339. That will give you how much?
267,335.
267,335. Any other relief again? I think there is no relief again. He's not married. We are not told whether he's married or not. He's not married. All these plenty investments, he doesn't have any child there. What's up? Or yeah, but he doesn't. He's not taking relief for them. Plus 267,339. So this is 510,639. So we now get his chargeable income.
So please, somebody should compute the social security again. I didn't get the 3,300.
Oh, it's 0.055 by 1069.
60,000. Please, somebody should call.
By 60,000.
It's 3,300.
It's 3,300. It's 3,300. What is the chargeable income? 558,704. That's the chargeable income. So you have to compute the tax. Now, let's move on and go and compute the tax. Point 14 mark is good for this question. You calculate workings number 2. Tax charge. So the first 5,880, the rate is nil. The amount is 0. The next 1,320 is 5%. This is 66. Followed by 1,560. This is 10%. This is 156. The next 38,000 is 17.5%. This is 6650. We move to 192,000. This is 25%. This is 48,000 Ghana cedis. I think we can do the remaining now, right? So the remaining, how much will be the remaining balance? But this one, the next, I think the next here should be 36624, according to the graduated rate. Is that not it? I believe so. I believe so.
Yes, 366.
So the remaining, I'm getting 319,944, which will be 30%. Somebody should confirm that.
Yeah, 319,940.
Yeah, 940.
940.
Yes.
Okay. So by 30%, how much are you getting?
95982.
982. All right. So this is 558,704. Total tax charge will be how much? You're getting 150,
854.
854. All right. Now let's compute his net tax liability. So total tax charge is 15854. Now let's compute his net tax liability. We know that the total tax charge based on the global income is 15854. Now let's find, before we can compute his net tax payable, we have to calculate the effective tax rate. Effective tax rate for Togo, the foreign country. Togo, what's the tax rate? On the rental income, we were giving the rate already. That's 20%. For UK, that's the dividend. The tax rate is 7.5. The Germany income, that's the interest,
8%.
8%. Now let's find the Ghanaian rate, the average rate of tax in Ghana. The Ghanaian rate, what we call the average rate of tax in Ghana. How do you calculate that?
Your tax amount divided by the chargeable income.
15854 divided by chargeable income is how much?
558,700.
704 multiplied by 100. What's the tax rate?
27.
27%. So it means that in Ghana, the tax rate is 27%. So the foreign tax rates, they are all lower than the Ghanaian tax rate. So all the tax that was paid in the foreign country will be given to him as a tax credit, unless he himself writes to relinquish his right. Then what you do is all the foreign tax paid, you give them as a deduction before you compute his net tax liability. So let's do that computation of net tax payable. The tax charged is 15854. We deduct the foreign tax credit. Deduct the foreign tax credit. So for Togo, what the tax paid in Togo? How do we get the tax paid in Togo? The rate is 20%. So 20% by what? What's the total income from Togo in Ghanaian city? 120,000. 20% of 120,000 give you 24,000. In UK, the tax rate is 7.5. The total income from UK is 200,000. 7.5 by 200,000, I think that'll give you 15,000. What the net received was 185,000. Then for Germany, the tax rate is what? 8%. That's it. So that's 8% multiplying. Total income from Germany is how much? 90,000.
90,000.
90,000. So that will give you 7,200. Now we give, so this is the total foreign tax credit. How much would that be? So this is 7,200 plus 24,000 plus 15,000. It's 46,200.
200.
All right. Now, we deduct the withholding tax credit. So the first one is what? The royalty. The royalty, the tax is 15%. So 15% by 78,000. That will give you how much? 11,700. Then we included the consultancy service. We say it's on account. The total tax is 7.5 by the 100 and by 12,000. Yes. That will give you 900. Then the insurance commission. So that will be 10% by the 10,000. This is 1,000. I think that's all the withholding tax credits. It's only 3 withholding taxes that are on account that we've added. So this will give 11,700 in addition to 900, in addition to 1,000. So this is 13,600. So his net tax payable will be what? So just add this one. 13,600 plus 42,200
91,045.
out of 150,854. 91,054. So this is his net tax payable. This is
045, sorry.
045. 054.
45, not 54.
Are you sure?
Yes,
It's
ma'am.
91,054.
It's 054, yes.
05.
So this is the A. Let's move on to the B part. So the B part, we are told that B, Mr. Kofi Kwarteng. We are told that he write to the Commissioner General to relinquish his right under Section 112. So it means that the tax he paid in the foreign country will be given to him as a deduction. The deduction. So this one, we have done the first part already. So what we do is we just take our chargeable income, then we less the foreign tax paid. Whatever amount we get, we tax that using the graduated rate. That's all. So computation of tax payable. How much is the chargeable income?
Five, 700.
It's 704. 558704. So the tax paid in the foreign country, we give him to him as a tax credit, No, we give it to him as a deduction. 1 minute here, let me. All right, so let's move on. So if you write to relinquish your right, it means that you don't want the tax paid to be given to you as a tax credit. So what you do is the tax pay, yes.
The royalty, what percentage do you use to gross?
15. To gross it,
It's
15%. The withholding tax on royalty is 15%. Why is that?
okay.
Yeah, the royalty is 50% to use. It means that the 15% withholding tax was deducted before he received.
Yeah, I'm with you. I'm with you. Continue.
Yeah, so we just gross it up with 85 using the 15%. Yes. So now let's take off the foreign tax. So we give a deduction to the foreign tax he has paid. So we deduct the foreign taxes that he has paid. Those one we have even calculated them already. We have calculated them already. Deduct foreign tax paid. So for Togo, the tax paid is 24,000. For UK, the tax paid is 15,000. And for Germany, the tax paid is 7,200. So the total deduction will be what? 46,200. So now the taxable income, how much will be that? Getting 512,504. So this is the taxable income. So now the tax charge. So I'll leave the question here. Calculate the tax charge using the withholding tax rate, using the graduated rate. When you are done, come and give the withholding taxes. We've done them here already. The total is 13,600. Deduct it from the tax charge before you know his net tax payable. That will be more than this. That will be more than the 91,504. I believe that's fine. So calculate the tax charge using the graduated rate. When you are done, take the tax charge, come and deduct the withholding taxes on account. We've done that calculation here already. The withholding taxes, the royalty, consultancy, and the commission. The total is 13,600. Deduct it from what you get before you know is net tax payable. Let me do one more question on international taxation. I think all the questions I have are very important. The one I can leave for you maybe the question 3, but I'll just explain the treatment, how the things will be. But it's very simple. Question 3 there is very simple. Very simple. Libby Limited is a resident company incorporated in Ghana. 8 trading partners have been customers and suppliers from Ghana and also from Nigeria. The company supply animals feed. Its operations for 2021 year of assessment is as follows. Income from Ghana, 10 million. Income from Nigeria, 1 billion. So this one, just convert it to Ghana cedis. I think we'll be giving the exchange rate. The exchange rate will be somewhere down there. Yes, 1 cedi is equal to 60. So just divide this one by 60. Whatever you get, add it to the Ghanaian income. That will be the global income. The following additional information is relevant. Allowable expenses granted by GRA. You deduct the allowable expenses 6 million from the global income. The allowable expenses does not include capital allowance. So come on, deduct capital allowance. Deduct capital allowance. The tax paid in Nigeria is 40 million naira. So the tax paid in Nigeria. Then you move on to the earned interest on T-bill. T-bill interest is exempt from tax. Ignore this one. The taxpayer has written to the Commissioner General to relinquish its right under the double taxation agreement. So it means that the tax paid in Nigeria, which is 40 million, convert it to Ghanaian cedi divided by 60. This is it means you have to deduct it before you get his taxable or his chargeable income. Then they give you the rate. That's all. When you do that, whatever you get, what will be the tax rate? It's a resident company in Ghana, so 25%. The tax will be 25%. Then you are done. For advanced tax, these are some of the questions they will give you. They will not load it like the question 2, what we've solved now. For 10 marks, these are some of the questions they'll give you. See, this one is for 8 marks. So they may add some 2 marks question to it, 2 theory for 2 marks to it, that's all. I believe I can move on to the next question, or I should still write the solution for question 3. This will be question 4.
Oh, we can move on.
We can move on here. All right. Question 4, the last question on international taxation. Pushi Limited is a Chinese company engaged in the manufacturing of car tires for sale in African countries, including Ghana. On January 1, 2023, the company launched a branch in Ghana to manufacture the car tires and sell them to Ghanaian customers. So they have a branch. They don't have a subsidiary. They have a branch that they have in Ghana. Kushi registered the business with the Registrar General Department as an external company and located the business in Kumasi. So Kumasi, you know, the tax rate 18.75%. The following are the result of the branch in Ghana in 2023 year of assessment. So gross profit, donation to Ghana Heart Foundation, this will be allowed. What about the support to the presidency? That be allowed? Support to the presidency, will it be allowed as a deductible donation?
For what purpose?
No.
Okay. So for what purpose? We are not
Ah.
told. We were not told.
Election year.
This is not a worthwhile cause. Disallow it. And don't disallow this.
Yes.
Why are you donating to the presidency for what? You want to win government favor. Forget it. So this one we do, you cannot deduct this one. We disallow this one. We disallow depreciation. Now there's some small changes we have to do on this question. The last item supposed to be off. Fresh graduate salary, the 1 million is a wrong addition. So this one, the total deduction will be 6. So do that calculation, do that changes in on your question paper. So this will be, the total deduction will be 6,500. So this will be 1,500. So the net profit will be 1,500. General admin, 4,500,000. All right. So additional information. The management of Kushi China Limited decided to extend its operations in Ghana. So the business hired 10 staff in Accra to sell the stationery manufactured in China, since the branch in Ghana always runs out of stock. The staff made a profit of 3 million. Now, the first requirement is, okay, I know there'll be a question on this, so let me move on. Kushi Limited is confused about how this profit should be taxed. Now, this profit, how will it be taxed in Ghana? The 3 million, will it be taxable in Ghana? The company hired 10 staff. The branch in Kumasi, that branch always run out of stock. So the company, they are being smart. They hired 10 staff in Ghana, in Accra, to sell the products, to sell the car tires. And at the end of the 2023, they make a profit of 3 million Ghana cedis. That profit, I'm asking, will it be subject to tax in Ghana?
Yeah, derived from Ghana.
Yes,
Derived from
it has
Ghana.
been
Yes.
derived in
Okay, so what will be the tax rate?
25%.
Thank you. So the tax will be
35%.
the tax will be 25%. So there will be tax on the 3 million because this amount is derived from Ghana. So tax 25%. The agreed capital allowance, so capital allowance is given. 5% of the workforce of the branch are fresh graduates, of which 800,000 Ghana cedis was paid and added to admin expenses. So this is the more reason why I'm saying this one is a wrong addition. It's a wrong addition. So the first graduates, they constitute 5% of the total workforce. They were paid 800,000. The 800,000 is part of the 4.5 million, which is the total administrative expenses. So it means that, there will be what? Additional deduction here. That's it. There will be additional deduction, right?
Yes.
All right. So 5%. What percent will be on the total wages paid to the fresh graduates as an additional deduction?
50%.
50%.
50%. I disagree. I disagree, Sinead.
It is above 5%.
5% is
Okay.
50% of their wages and salary.
It's
Uh,
30%.
It's what, Syria?
Mm.
It's what
Above,
percent?
above 5% will give you 50%.
Uh-huh. So this one, what percentage are we using?
They say 5% exactly. So
30%, 30%.
30%.
Yeah. So this will
1 to
be
5 is 30%.
30%, yes. 0 to 1 is 10%.
10%.
1 to 5 is 30. The
30%.
above 5 is 50. So 30% of the 800,000 will be given to them as an additional deduction. Now, the admin expenses included an interest of 500,000 on a loan of 16 million taken from Kushi Limited. The equity capital of Kushi is 1 million USD. The exchange rate is $1 is equal to 13 Ghana cedis. So, this one, this interest will be subjected to the T capitalization rule, the debt to equity ratio of 3:1. So, you know how you are going to do that calculation. It means that the 500,000 is already included in the what? In the 4.5 million. So, we have to find out. Out of the 500,000, how much will be allowable deduction for tax purpose? So the debt to equity ratio is 3:1. So the 3:1, the equity is 3. Equity is 1 million USD. We convert it to Ghana cedis. So we multiply by 13. Is that not it?
Yes,
So that will give us 30 what? 13 by
that's
this will
39.
13, this is 13 million.
Yeah,
By 3, that will give you 39 million.
yeah.
So the interest will be 39 million divided by 60 million, multiplied by the 500,000. The amount you get, that is the amount that can be deducted from income before Kushi branch Ghana will pay tax. The excess amount will be what? We add it back to the income and tax. We add the excess amount, but because all the 500,000 has already been deducted, so we add the excess amount back. So basically, that is the question. That's the question. So let's go through the requirements of the question. Now, briefly discuss whether Kushi is trading in Ghana or trading with Ghana. Explain how Kushi should be taxed. Now, based on the information relating to Kushi Limited, are they trading with Ghana or they are trading in Ghana? Are they trading with Ghana or they are trading in Ghana?
They are trading in
They are trading what?
Ghana.
All right. So how would they be taxed?
10.7.
They be taxed at what? How would they be taxed?
18.75.
18.75.
Yeah,
All right. Because they are in Kumasi, right?
yeah.
But I see, when you write that, you cannot get your 4 marks. No. You see, this question, if you say, Kushi Limited, based on the information provided, they are trading in Ghana, and they'll be taxed at the rate of 18.75%. The examiner can the examiner can even verse and give you 1. You see, this one, you have to explain the concept. You see, that what you said, the mark is 2. That is 2. That should be the concluding part of your answer. You should explain the concept first. What is meant by trading in Ghana and trading with Ghana? Then, based on the explanation, tell the examiner that Kushi Limited is trading in Ghana. And when you are trading in Ghana, the tax don't even mention, if you don't even mention the 18.75, it's not even needed. Based on the explanation, they are trading in Ghana and they will be taxed as what? A resident entity, a resident company. If you are trading in Ghana, that is classified as what we call a permanent establishment. Let the examiner know that you know what you're writing, you know your stuff. If you are trading in Ghana, that's what will be classified as a permanent establishment. And permanent establishment will be taxed as a resident company. So in that case, Kusi Limited will be taxed as a resident company. They are allowed to withhold tax on payment that they made. They are allowed to prepare their returns and file their returns. So at the end, you can conclude and say that they are located, the branch is located in Kumasi. In that case, they'll be taxed using at the rate of what? 18.75%. So don't just write the concluding part. Explain the two terms, trading in Ghana, trading with Ghana, before you give your concluding, so that I can get your full marks. Now, the B part, the B requirement, discuss the tax implication of the loan taken from Quishi Limited. I think we have even done that already. So this one, they say discuss. The mark will be more than 2 marks. Quishi Limited and the loan they give to the branch, they will be classified as persons in a control relationship. A company and your branch, you are in control relationship. And any loan that the parent gives to the branch or the head office gives to the branch, interest portion on that loan will be subject to the thin capitalization rule. So you do the calculation, and tell let the examiner know. Now, profit made by the staff located in Accra, we spoke about that one already. That income is derived in Ghana. And those people, they are trading in Ghana. So their profit of 3 million will be taxed at the rate of 25%. So you do the calculation and tell the examiner the tax amount. How is Quichi's branch different from a subsidiary company? So this one, the examiner wants to know if you understand the differences between a branch and a subsidiary. Branch and subsidiary, are they the same?
No.
So what are the differences?
A branch is registered under. Is it? No, which one the permanent established? See now, which one is the P? The
Oh,
subsidiary of the branch.
a branch can be a P. Subsidiary can be P. All of them can be P.
A branch can be an extension.
You know, a P, if you have a physical presence in Ghana, if you have a fixed place of business in Ghana, then that will be classified as a P. One-off transactions cannot be classified as a P. So kindly revise your notes on the P. What constitutes a Ghanaian permanent establishment? If you have a place in Ghana that you are providing service, there's a fixed location of the business, that can be classified as a P. A place you are rendering service, a long-term contract that will last more than 12 months, that can be classified as a P. A place of management of the business alone is even a P. If you have an office, that's a P. So a branch can be a P, a subsidiary can be a P. But what are the distinctions between a branch and a subsidiary? That's what this question is trying to seek for 4 marks. So at least try and raise 2 points. So what will you write to get your 4 marks?
Say,
Yes.
Senior. Okay, me, a branch is just an extension of the parent company.
Okay.
And then a subsidiary can be a limited liability, still under the parent company. Or
Is it a question or you want to continue?
Okay, let me come in.
Okay, so what I'm trying to say is a branch is just an extension of the parent company.
Okay.
But a subsidiary can stand on its own, prepare its own account, and do everything on it. Yeah, that's what I want.
So this one, there's no or again.
No.
Okay, thank you. That is very fine. A branch is just an extension of of a company. You have a company, you just want to extend the company, extension of the main company. But a subsidiary is a separate legal entity which can be fully or partially owned by another company. Subsidiaries are always required to keep separate book of account. Subsidiary cannot keep the same book of account with a parent. How? How will you consolidate? How will you consolidate? Subsidiaries are allowed to keep separate books of account. But a branch can decide to keep separate book, or they can decide to keep an account with the head office. So normally a branch, they report to the head office. But a subsidiary, they report to the holding company, the company that holds the majority share, the holding company. So that's how can. So if you see this Kushi's branch, it's a branch. It's not a subsidiary. It's not a subsidiary because they just extend part of their company to Kumasi. So that is a branch. That is not a subsidiary. So you write these two distinctions and you get your 4 marks. State 4 different means under which Kushi can operate as a Ghanaian permanent establishment. So I've already answered this question. They can have their office. If they have office in Ghana, that will be classified as a permanent establishment. If they have a branch in Ghana, they already have a branch. If they can have a subsidiary, they can decide to have a subsidiary that will do the same business with them. That will be a subsidiary, that will be a permanent establishment. If they have any fees place of management of the business, that will be classified as a Ghanaian permanent establishment. All right. Compute the taxes payable by the branch to GRA, if any, 5 marks. So let's compute the taxes payable. Then we move on to value added tax. Value added tax, I don't have anything more to say. So I think this is question 4. Kushi Limited Ghana branch. So make sure you write the basis period and the year of assessment and the rest. Always make sure you write them. So computation of tax payable. All right, so we start with the net profit. That will give you 1.5 million. Are you guys okay with the 1.5 million net profit? Are we okay with the net profit? We add depreciation. How much is the depreciation?
1 million.
1 million.
Yeah.
We add support to the presidency. Support to the president. Senior Richmond, kindly mute your mic, please. All right, thank you, Senior. Support to the presidency, 500,000. We add it back. Now, let's go and do the interest. So let's do the workings on the loan taking. So allowable portion of the interest paid. So let's calculate that. Now the equity will be equal to what? How much will be the equity? I think there is one. The equity will be what? That will be 1 million USD by 13 Ghana cedis. So this will give us 13 million. So the total equity will be equal to 13 million multiplied by 3. And we said earlier this will give us 39 million. Now, the loan is 60 million. The loan is 60 million. So total interest paid will be equal to, so how much was the interest paid? 500,000.
Yes.
All right. So allowable portion of the interest paid will be equal to 39 million divided by 60 million, multiplying the 500,000. How much are we getting? How much are we getting?
325,000.
325,000.
Yes.
Okay. So 325,000 can be allowed. So interest disallowed will be equal to the 500,000 minus the 325,000. That will give us how much? This will give you 175.
Yeah, 175.
All right. So go back, add the 175 back to the income and tax. So we add disallowed interest, 175,000. The total is will be give you how much? 1,675,000. Hey, we are adding back. I like to deduct. I like to put things in bracket. If you add back, how much will you get? 3,175,000. All right, so let's deduct capital allowance. How much is the capital allowance? 600,000. We take fresh graduate, additional deduction for the fresh graduate. That will be 30 by the 800,000. How much will you get? 240,000. This will give you 840,000. So the chargeable income will give you, this will give you
2,535,000.
2,535,000.
Yes.
Can somebody confirm that figure?
Somebody should confirm.
2,335,000.
2,335,000. So we charge our tax at 18.75%. How much will be the tax?
4,378,12.5.
4,378,12.5. So this is our tax. This is the tax payable for the year 2023. All right, we are done with international taxation. Kindly take your time, revise all the questions we have solved, and I believe we will be fine. I believe we'll be fine. Another question before we move on to VAT. VAT, I'm just running over VAT. Because I think the very first day we talk about VAT. And the VAT, the most important thing in the VAT is the theory. So you have to take your time, read through the theory, and you'll be fine. Now, the calculations are very simple. The simple one is when you are given the amount of supply, amount exclusive of VAT and the levies. Amount exclusive of the VAT and the levies. In that case, just compute your levies, add the levies to the amount of supply, get the taxable value, find the VAT of 15% on it. Then you are good to go. Now, before we can get this tax that we are calling VAT, value added, first of all, there must be a taxable person. So you have to know who is a taxable person. And there must be a taxable person. There must be something we call taxable activity. Taxable activity. So that activity should be taxable. So normally the taxable activity, we say supply of goods. There must be supply of goods or services. There must be supply of goods or services. Now, for the VAT, normally we use the invoice credit system. So we use the input-output system. Now, if you are, I'm saying that for VAT, there must be a taxable person. So taxable person is someone who is registered with VAT, with GRE. So if you are registered, if you are a VAT registered person, you will be classified as a taxable person. So there is registration requirements that you have to know. So there are 10 NOVA registration requirements. So annually, 200,000 Ghana cedis. If you're a person that you know on annually basis, you'll be making a taxable supply, either of goods or services, that the value will reach 200,000 Ghana cedis. Then you have to apply to GRE and register. On quarterly basis, we have 50,000 Ghana cedis. So for every 3 months, if you know you are going to make a taxable supply, that the value will be 350,000 Ghana cedis for every 3 months, then you have to apply to the GRE and register for VAT. You have to apply to GRE and register for VAT. So when you register, then you become a taxable person. Now, taxable activity. We are saying that you can only get VAT if the activity is taxable. So you must know what constitutes supply of goods or what constitutes supply of services. Very, very important. You have to know them. So supply of goods is a transaction where the owner parts with ownership of the goods. So it could be through sale, through exchange, through gifts, and the rest. Supply of services, it could be you make your place available for services. You render services for someone for a consideration. Before you can charge the VAT, the consideration is very, very important. Now, for the registration threshold, there are some group of people that whether they meet the turnover rules or not, they have to register. So there are three. A promoter of public entertainment. If you're a promoter of public entertainment, 48 hours before the date of the event, that means 2 days before the date of the public entertainment, you have to go and register for VAT. If you are an auctioneer, from the date you become an auctioneer, you have to go and register for VAT. It could be if you are national, international, regional, local government bodies, you have to go and register for VAT. You don't even need to meet the registration requirement before you register for VAT. Now, the VAT system, we have the standard system, which is the rate is 15%, and we have the flat rate system, which the rate is 4%. For the flat rate system, the VAT rate itself is 3%, then plus COVID levy is 1%. Now, we are saying that the VAT, for the standard system, the VAT is chargeable on what we call taxable amount. Taxable amount. So the taxable amount is what we call the levies inclusive amount. So when they give you any amount in the question, check and see if the amount is levies inclusive or is levies exclusive. Normally, when they said invoice amount, before you can invoice somebody, the invoice amounts, before you can give your invoice to a customer, it means definitely you are going to include the VAT before you give the invoice amount. So sometimes the question just said, the person invoiced the goods at this value. Then they will tell you whether the levies are part or not. Immediately you invoice somebody, you give the VAT invoice to somebody. It means you must include the levies. You must include the levies before you can be able to, before you know the total value. So take note of the amount, whether the amount is levies inclusive or levies exclusive. And for the VAT system, we use the invoice credit system, which means that we get your input VAT and your output VAT. So at the end of every month, VAT is payable. If you are a VAT registered person, VAT is payable on monthly basis. So every month, the input VAT that you have made, the VAT you've paid on all purchases you have made relating to your business, and the VAT you have charged your customers based on the sales that you have made. You compare the two. So first of all, you net the input VAT against the output VAT before you pay the net to the GRE. You net the input against the output before you pay the net. Now, if the cost, which is the input VAT, is more than the output VAT, which is the revenue, then it means you have extra cost. You're allowed to carry that cost forward for the next 6 months. For the next 6 months, you can carry this cost forward and deduct it from any output VAT that you make. After when the 6 months elapse, then you cannot carry it forward again. You're allowed to carry it for the next 6 months. So that's the system we use. So the levies inclusive amount, that's what to compute the VAT. Now, the most complicated question they can give you is when they give you amount inclusive of VAT and levies, then the person want to know how much am I paying as the levies. I want to know each of the levies. How much am I paying? National Health Insurance levy, how much am I paying? Get fund levy, how much am I paying? COVID levy, how much am I paying? Communication service tax, how much am I paying? So when they give you the levies and VAT inclusive amount, then you have to extract the VAT and the levies amount from the figure. The person want to know the goods, how much am I actually paying for the goods? Or the levies, how much am I paying? So when they give you, let's say they give you 200,000 as the levies and VAT inclusive amount. I want to know how much am I paying at the levies. So for the levies, we have National Health Insurance levy. The rate is 2.5%. You have Get Fund levy. The rate is 2.5%. You have COVID-19 levy. The rate is 1%. So the total levies are 6%. Then the VAT itself is 15%. 15%. The VAT will be charged on the taxable amount, which is the levies inclusive amount, Now, there are some communication service tax is 5%. So if the company engage in telecommunication activities, the pay tax, communication service tax, which is 5%. Now, this will be included as part of the levies before you charge the VAT. It's a tax, but it will be part of the levies before you pay tax. Now, this simple approach, I believe this one I even gave it to you guys on the very first day, but let me just brush through it so that we move forward. Now, if the amount is 100 cedis, if the amount is 100 cedis, let's say it's 100, then it means that when you add the levies, so I'm saying that the supply, the amount of the supply is 100%. So amount of supply is 100%. Then the levies, 6%. So this will give you 106%. Then the VAT will be added. So when the VAT is 15% added. So this will give you what?
One.
What plus would the VAT be 15%? The VAT will be 15% of this amount. Is that not it? So the VAT will be 1.15 by 106. So this will give you 15.9.
15.9.
So the total will be 121.9. The VAT will be 15% on you cannot just add the 15% directly, no. The VAT will be 15% on the levies inclusive amount. So that will be 15% of 106. That will give you 15.9. So the total VAT or the total amount will be 121.9. Now, if there's a communication service tax, take note. If there's a communication service tax, it means that the levies will not be what? It will not be 11. It will be 5 plus 11. So you have your 100 plus 11. This will give you 111. Then you charge the VAT. So the VAT will be what? 15% of 111. This will give you 16.65. So the total will give you 127.65. So this will be the base that you'll be using. So when they give you the levies inclusive amount, And this one, there's no communication service tax to take note. So the 200,000, there is no communication service tax. And you ought to get the original value on which they charge the VAT and the levies. The original value will be the 100%. So just do 100 over the base, 121.9 multiplied by the 200,000. If you do that, you get the amount of the supply. That is the original value, the value on which they computed the VAT and the levies and the VAT. So this is this will give you 164,068.9. We make it 0.91. So if you take this value, if you get this value now just go and compute your get fund on it, your COVID on it, 111, the COVID on it, 111. Add it back again and apply the VAT of 15% on it. You'll get the 200,000. If there's a communication service tax, so let's say this 200,000, there's a communication service tax, which is included in the levies and the VAT, then just do your 100 over 127.65 multiplied by the 200,000. Whatever you get, that will be the original value. That will be the original value. So 100 divided by 127.65 multiplying 200,000. So we will get 156,678.42. So this is the original value. So just take this value, find your COVID, the get fund like 2.5 on it, national health insurance 2.5, COVID 1%. Then you find the communication service tax again, 5% on it. Add all of them back. Then whatever you get, that will be the taxable value. Multiply that by the VAT rate of 15%. Then you will get, if you add everything together, you get the 200,000. Or you can use the standard approach. You can use the standard. There are two approaches. This is one I've given you. Or you can use the standard approach. If this amount is VAT and levies and everything inclusive, then find the VAT first. So the VAT will be 15 over 115 multiplied by the 200,000. This will give you the VAT component. Take the VAT component out of this amount. Then the amount you get, come and find the levies on it, 11111. Then that's all. Then you are good to go. If this will work for you, simple. And if you are doing the levies will be the 2.5, get fund will be 2.5 divided by 106. National health insurance will also be 2.5 divided by 106. COVID will be 2.5, 1 divided by 106. If there is a communication service tax, know that the base will be 111. So after you take the VAT out, the base will not be 111. So the get fund will be 2.5 divided by 111, multiplied by whatever value you get. COVID will be 1 divided by 111. Communication service tax will be 5 divided by 111. Then you are good to go. Another question before we move on to the questions I have in the notes. There is withholding tax system. That's withholding tax system. So if you are a VAT withholding agent, you are allowed to withhold 7%. So the VAT withholding tax is 7%. So you are allowed to withhold 7% from the payment, from the taxable value, and pay that one to GRA by 15th of the following month on behalf of your customer. So it's very simple. If let me go to the next page. If A is an withholding agent, A is the agent, and A is making, B is buying from A. So A is the agent, which is the one selling. And A is selling to B. A will include the VAT, then the transaction is a taxable supply. It's a taxable supply. A is the agent. A is required to withhold 7% on the taxable value and pay that one to GRA on behalf of what? On behalf of B. Now, the VAT component is the person buying the goods. You are the one who will pay the VAT. The person buying, the buyer, you will pay the VAT. So the VAT you are paying, you'll be allowed to deduct that VAT. So you are the one buying. So that will be input VAT for you. That will be input VAT for B, but it will be output VAT for A. It will be output VAT for A. Now, A is the withholding agent. So the amount. So let's say the taxable supply on which the VAT is charged is 200,000. The taxable value on which the VAT of 15% will be charged on it. VAT of 15% will be charged on it. So this value, A is allowed to withhold 7% of it. The 7% is the portion of the VAT. VAT is 15%, so you're left with 8%. So B will only pay the 8% VAT at the end of the month because 7% are already be deducted and paid on behalf of B. So B will be allowed to just pay 8%. But what B will do is at the end of the month, when B is preparing his or its returns, B will still include the 15% VAT, the total VAT. Then the 7% VAT withheld will be given as what? As a credit. So B will deduct the 7% withholding VAT before paying the net to GRA at the end of the month. I hope that explanation is on point. It's okay. So that's the withholding VAT system. So if you're an agent, you are required to withhold 7% of the taxable supply you are making. Because the taxable supply, that is the value at which you are going to charge the VAT. So the VAT of 15%, you withhold 7% for now. The 7% come and pay. We need that money upfront so that we can be using that money to what? To be developing the country. So at the end of the month, so that B can now come and file 8 VAT returns and pay the VAT, then the one withhold we give it to B as a tax credit. So when A withhold on B, A have to give B a VAT tax credit, VAT withholding tax credit certificate, which shows that the tax has been withheld and has been duly paid on behalf of B. Let's move on to, now you have to know, before we move on to the questions, you have to know what we call exempt supply. There are some supplies that are exempted from what? From VAT. So you need to know exempt supply. So that in a question, when they give you exempt supply, you don't go and include it in the calculation. So your duty to know exempt supplies that are exempted from withholding tax. So the most common one, supply of agricultural products in the raw state, supply of live animals and the rest. So take your time, know the exempt supply. We say taxable supply. So definitely, so far the taxable supply, there will be exempt supply. No relief supply. Supplies that are relieved from VAT. The first one is supply to the presidency. If you are making a supply to the president of the republic, you don't charge VAT on it. No, you don't charge VAT on it. So supply to the presidency, it's a relief supply. Then a relief supply may be emergency supplies. So that one, then the minister have to come in, get the parliamentary approval that based on the emergency situation, we want you to relieve some items from VAT. So during the COVID-19, the finance minister went to parliament, listed some items that want those items to be relieved from VAT so that the price can be lower for the people to buy. So emergency supplies are relief supplies. Then we have zero rated supplies. This one, the VAT rate is 0. They are taxable, but the VAT rate is 0. So basically all supplies for export. If you are making a supply that the goods will not be used in Ghana, the goods will be used outside the borders of Ghana. That is a zero rated supply. It means that the input VAT is there. The input VAT is there. The VAT you paid on the material that you buy is there, but the output VAT is 0. The output VAT is 0, but the input VAT is there. So if they give you zero rated supply, it's a taxable supply. So when they ask you to calculate taxable supply, you include the taxable supply in it. It's a taxable supply, but just that This one, that is what the rate is 0. The rate is 0. So all supplies for export, the input VAT is there, but the output VAT is 0. Another question before we move on to the questions I have in the revision document. These questions, I will not be solving them. We'll just be discussing them together. There are questions that are not anything for me to be writing the solution. So I'll just be doing the calculation here fast, because I've already explained everything. SYZ Limited is into mobile telecommunication and manufacturers of what? Scratch card among others, among other products for sale. In October 2022, it sold scratch card amounting to 3 million Ghana cedis to the public. SYZ Limited intends to appoint you as acting assistant accountant pending confirmation after successful completion of your ICAG examination. As part of the engagement, you are to assist the company file its return with the GRE. Compute the following taxes from the above data to aid the filing. So how are you going to do this calculation? How are you going to do the calculation? Are we here? Are we together?
Yeah.
We are here.
How are you going to do the calculation?
Yeah, so the $3 million is the invoice amount. And so you would have to, CST is 5%, value added is 15%, NHIL 5, get fund 2.5, and COVID 1%. So in this case, you would have to solve it individually.
Okay.
Yeah.
So then, Nathaniel, if you are talking,
Yes, sir.
if you are talking, so we have to do it individually, right?
Yes,
so this is the invoice amount.
Yes. So the first that we'll calculate our VAT, the first amount. Then once we get our VAT, we less it before we compute other communication service as Nation, NHI, get funds.
Okay. So this one, the first.
Please, is it Nathaniel? You are saying you have to calculate your VAT 15% on it. You less it before you calculate your communication service NHIL.
Yes.
Yes. Because the reason I'm asking that, what I know is, you see, when you get the invoice amount, you have the tax exclusive amount and then the inclusive amount. So it is the exclusive amount that you will calculate all these things, but you also calculate the VAT to get the total amount, the total invoice amount.
Okay. So Namiche, your explanation is the 3 million does not include the VAT and the levies. Is that what you're saying?
It does not. Yes, this is the exclusive amount.
It sold scratch cards amounting to 3 million. This is the amount that he sold the scratch card. So
okay,
he sold the scratch card. You see, this is telecommunication. All this one, the VAT is, and everything is inclusive. For telecommunication, mobile devices, the scratch card, the VAT, everything is included. Before you sell, you have to include everything before you sell. Are you with me?
yes.
Yeah. So this is the invoice amount. So it means this amount involves the levies and the VAT and the taxes. Everything is there. You cannot sell a scratch card, telecommunication device, a scratch card without charging the VAT and the levies and the communication service tax. No.
Okay.
So it means that this value, everything is included. So what you do is, that's the explanation that Nathaniel is giving. this amount, everything, then VAT.
But why I don't understand this, he's saying we have to less the 15% before.
Yeah, that's one approach. You see, if per the explanation I gave earlier, I said if the amount is the VAT and the levies inclusive amount, it means that this 3 million, everything is part of the 3 million. The VAT, the levies, the communication service tax, everything is based here. So for you to know each of them, how much will be for communication service tax, how much will be for value-added tax. I gave two approaches. The second approach, that's why he is using. So the second approach is, first of all, calculate the VAT on this amount. So the VAT will be 15 over 115, multiplying the 3 million. Multiplying the 3 million. What you get? How much will you get? So the VAT will be 15 dividing 115, multiplying the 3 million.
391,304.
304. Nearest whole number, 304. So it means that the VAT, that's the VAT amount. This is the VAT component, 319,304. This is the VAT component. Now, before you can compute the levies and the communication service tax, take the VAT out of the 3 million. So it will be the 3 million minus 391,304. How much will you get?
260,869. So 260. 870.
870. It will be more than that. It will be more than that. 2608.
2608.
696.
95. Yes.
So what you get is 2608,696. Now, 696. Now this value, it means this value is the levies inclusive amount. The levies and everything is here. The levies, the communication service tax, everything is in this value. Now strike them one by one. Now there's a communication service tax. The levies are 3. The levies are 6%. 2.5, 2.5, 2.5, that will give you 5. Plus the COVID, that is 1, that is 6. Plus the communication service tax, which is 5. So this will give you 11. So for you to get the National Health Insurance Levy, you have to do 2.5 divided by 111, multiplying this value. What you get straightforward, that is the amount for the National Health Insurance Levy. For the Get Fund Levy, it will still be the same thing, 2.5 divided by 111, multiplied by this value. For the COVID levy, it's 1%. So it will be 1% divided by 111, multiplied by the 2 million, 2.608 million. Therefore, the communication service tax, it will be 5% divided by 111, multiplying this value. Then you are done. That's all. That is one approach. The second approach I was saying is that there's a communication service tax here. So the base will be 127.65. So for you to, if you want to know the original amount on which they charge the VAT, the levies, and communication service tax, do 100 divided by 127.65, multiplied by the 3 million. How much will you get? You get 2,350,176. It means that this is the original amount at which they charge the VAT and the levies. Now, this is the amount. So you assume that this is the amount of the supply. Now, come and calculate your VAT, the levies first, 111. So this value, calculate your Get Fund levy, 2.5 by this value. National Health Insurance, 2.5 by this value. COVID, 1.5 by this value. Communication service tax, 1.5 by this value. add them before you come and calculate your VAT. That's all. You will still get the same answers.
The first method is very simple. You don't need
The first method is very simple.
simple.
Yeah, that is the method in the practice note.
So we have to
that's the method in the practice note. So GRA themselves, that's the method they use. That's the method they normally use.
That's cool.
So yeah. So if there is no communication service tax, it means that the base will be what? It will be 106. Is that not it? Yes. Using the first method that our senior is proposing. If there's no communication service tax, the base will be 106. So after you calculate your VAT, 15% over 115 multiplied by the 3, you get this value 2608696. If there is no communication service tax, the base will be 106. So for you to get the levies, the National Health Insurance levy, that will be 2.5 divided by 106, multiplying the 2.2608696. To get the COVID, 1 over 106. To get the get fund, 1 over 106. That's simple. You are good to go. As I said, I won't solve the question. I've even done solving the question. So I'm done solving the question.
Okay. So if the question is silent, we assume that the amount given is tax exclusive.
Wait, if the question is silent, if that is the invoice value, if the question said invoice amount, or the amount they sold the goods, it means that everything is part. It means that everything is part. Sometimes the examiner will be fair. They will tell you. Sometimes they can tell you that that is the invoice value, but they will put into brackets the amount is exclusive of levies and VAT. Don't say that it's a levies value. It's a levies, that is the invoice amount. But examiner, why is the examiner telling you that the levies are not part? No. The examiner is saying that the invoice amount, but the levies and VAT are not part of it. That one is simple. Just go and multiply the amount, calculate the levies first, add it, and come and calculate your VAT. That's all. Sometimes they can give you invoice value, but they will still put into brackets. The amount is inclusive of the VAT and the levy. The examiner does not want any ambiguity in the question for you to be assuming. Because if the question is like that, some candidates can assume that the levies are not part. The examiner, you don't have any right to mark them down. But on the normal, if that's the invoice amount, it means that the VAT and the levies, everything is part of it. But if the candidate also assume that they are not part, the candidate use the calculation, the examiner, they will still mark the candidate. So to avoid the ambiguity, the examiner will tell you that the amount is inclusive of the levies and the VAT. So that one, you know there's no ambiguity there. All right. Outline 2 circumstances under which the GRA may refund excess tax paid by a person under the provisions of the value-added tax. So if you pay tax in excess, there are some conditions that if you satisfy them, the tax paid in excess will be refunded to you. What are some of those conditions? What are some of those circumstances?
One is when the input tax deduction is more than the output.
Come again. When the input is more than the output?
Yes.
Oh, that is not excess tax. It means that is excess cost. So that one you have to carry it forward.
Okay, so one is when the Commissioner General, without reasonable doubt that there is an error in the computation of the withholding tax.
All right.
Yes.
All right. Thank you very much. All right. So if the commissioner believe that, okay, you make mistake in computing the VAT, and due to the mistake, the VAT you have paid is more than what you are supposed to pay, they will refund you the excess tax. They will refund you the excess tax. State 3 specific difference activities that will not constitute supply of goods or services. What are the activities that will not constitute supply of goods or services?
One of them is when an employee, the employee-employer relationship.
All right, all right. So you perform services for your boss, your employer, due to your status as an employee. That cannot be deemed as a supply of goods. You are just performing your duties based on your employment. So that cannot constitute supply of goods and services. Supply of money. Supply of money cannot constitute supply of goods and services. So these questions, use the notes and read on them. What name is this? Pamela New Limited is a non-resident person. The company's procurement officer came down to Ghana to buy 10 Toyota vehicles manufactured by Safu Katanka to be delivered in Mali. This is supply for export to be delivered in Mali. The vehicles are going to be used in Mali. The vehicles will not be used in Ghana. They'll be used in Mali. The vehicles were manufactured in Ghana. The management of the Pamela New Limited requested that the vehicles be serviced in Ghana by high-class mechanic, popular mechanic in Accra. What is the value-added tax implication on the vehicle to be acquired? So for the vehicle to be acquired, what will be the VAT implication on the vehicle to be acquired? The person acquiring the vehicle is a non-resident person. They are coming to Ghana to buy them. The vehicles were manufactured in Ghana, but the vehicles will not be used in Ghana. The vehicles are to be used in Mali. So this is supply for export. So what is the VAT implication of the vehicles to be purchased in Ghana? What is the VAT implication?
It will not be taxable. It will be exempt from VAT.
Will it be exempt from VAT? Will it be exempt?
No, it will be zero rated.
All right. It will be zero rated. Supply for export. All supply for export are zero. It means that they are taxable. It means the input VAT is there. So to Safu Katanka, in manufacturing the car, all materials you buy, you pay the input VAT. But so far as the vehicles are going to be used in Mali, they are not going to be used in Ghana. It will be subject to VAT, but at zero rate. At zero rate. Right. Then what about servicing the vehicle in Ghana? What is that? Would that be taxable in Ghana? Servicing the vehicle in Ghana?
Yes.
All right.
Yes.
That one, it will be taxable
Yes.
in Ghana. Yes. That one, servicing of the vehicle in Ghana will be taxable. All right. According to value-added tax, a tax known as value-added is imposed, which is applicable to the supply of goods or services within the country, except for those that are exempt. The importation of goods or services, excluding exempt imports. There are some imports that are also exempted. Unless the item is clearly exempted under the VAT Act, then the item will not be subject to for VAT. Now, based on the Act, what is meant by supply of goods? I've already explained this, and what is meant by supply of services. Notwithstanding the turnover threshold, yes, take the exemption to the turnover rules. I've already explained this. Ajepa Steel Works Limited supply iron rods to Okule Construction Limited in January 2024, with the total cost amounting to 500,000. You see, inclusive of the National Health Insurance Levy, Get Fund Levy, COVID levy, and the value-added tax. So this amount, examiner does not want any ambiguity. So they are telling you that everything is there. Calculate the health insurance levy, all of them, the approach you use. So this one, you can just calculate the VAT on it, 15% on it. This one, there is no communication service tax here. So just calculate your VAT, 15 over 115 multiplied by the 500,000. That's the VAT. Take it out. The amount you get, come and calculate your levies. Health insurance levy to be 2.5 divided by 106 multiplied by the value you get. Get fund, 2.5 divided by 106. COVID, 1 divided by 106. Then you get your 5 marks. Petrol Limited, a VAT registered trader, supplied goods to Petra, who is also VAT registered. A VAT invoice was issued by Petrol on 15th March 2023. On 20th March 2023, Petra received a call from Petrol informing them that the VAT invoice had been lost. What actions should Petra take in this response? What should be the action? What should be the action? You lost the VAT invoice and you inform the person that you bought the items from. So what actions will you take? Is it the VAT invoice? Is it in duplicate or is it in triplicate?
Interpret it.
So why you give out the original, the duplicate should be there, is that not it? So in case
Yes.
you lost your VAT invoice, you just apply, just call the person you bought the goods for, inform them that you've lost the VAT invoice. Then the duplicate is there. The duplicate will be issued to you. Then you take the duplicate. Then you can use that to claim your input tax deduction. So that's one thing. That's one rule on deductibility of input VAT. This is why you lost your VAT invoice given to you, the original given to you. Why you lost it? You have the remedies are there. Apply to the person you bought the goods from. Try and see if you can get the duplicate. So if you did not get the duplicate, and the commissioner general believe that, okay, you not getting the duplicate or you losing the VAT invoice, it's not your fault, he can allow you to deduct your input VAT. But if you lost your VAT invoice, you did not take any steps to get if you can get the duplicate. You have not, you are just sitting down there. They will not allow you. So when you lost your VAT invoice, try and see, go to the person who gave you the invoice, try and see if you can get the duplicate. Then you can use that to have your input VAT deduction. If you don't do that, the Commissioner General will not allow you to deduct the input VAT. During the month of March 2024, MSL rings telecommunications, so 800,000. Okay, this amount, is it levies, is everything part of this amount? Issued an invoice of 800,000 to a customer, said Ronlis Limited, also a tax resident in Ghana. Both companies are registered for VAT, and ERTL is a provider of electronic communication services, as defined in that, has also been appointed by as a VAT withholding agent. All right, the invoice was what? All relevant taxes, inclusive of all relevant taxes. So it means the 800,000, all the taxes are there. Then to telecommunication, so that should tell you that there's a communication service tax also there. There's a dispute between the finance manager of SRL and the tax director of ERTL regarding the computation of the taxes. You have been consulted in your capacity as a chartered accountant to assist. So just compute all of them. So the 800,000, there's a communication service tax. Take note of that. So you know how you do that. First, compute the VAT first, 15%, 15 over 115 multiplied by this. Take it out. The base now will be 111. So the communication service tax will be 5 over 111 multiplied by the value you'll get. As a VAT withholding agent, determine the amount of withholding VAT that has to be withheld. So when you get the taxable amount, 7% to be withheld. 7% to be withheld. So the rest of the questions, I think they are something brief questions for you to go through. Now, the last two topics, fiscal policy and tax admin, basically they are theory questions. This side is 20 marks. 20 marks question. So fiscal policy is 10 marks and tax administration is 10 marks. And it is your duty to know what entails in the fiscal policy. Fiscal policy normally moves with monetary policy. And the monetary policy is normally used by the Bank of Ghana to regulate the flow of money in the system. Fiscal policy is used by the government. So the other name for fiscal policy is government budget. So fiscal policy, briefly, is the use of government revenue and expenditure, which is the budget. So the budget, you may have deficit budget, and you may have a surplus budget. And in question, they can ask you how to finance deficit budget, how government can finance deficit budget. So in financing, but for advanced audit and assurance, the focus is on fiscal policy. There is nothing on monetary policy. The focus is on fiscal policy. There's nothing on monetary policy. And fiscal policy, basically, we have two types of fiscal policy. The types are automatic stabilizers and discretionary fiscal policy. Under the discretionary, we can have the expansionary fiscal policy, or you can have contractionary fiscal policy. Know the meaning, the explanation. Automatic stabilizers are there. In terms of automatic stabilizers are there. For those who are government does not need to incur any additional expenditures for them to come and stabilize the system. When automatic stabilizers, when are they normally used? Is it during inflationary period or during the other word is what? You have when there is an inflationary system. That means the inflation rate is very high. The reverse is what? What the reverse? When the economy is in what? What that word?
Is it recession?
Yeah, recession. It's recession. It's recession. The recession, what's the meaning of the recession? What's the meaning of the recession?
A gradual decline of the economy.
Yeah, the economy is declining gradually. The economy is declining gradually. So this is the time that the automatic stabilizers will come in. So if you want to stabilize the system, then the government can just trigger the automatic stabilizers. They will come and make sure they stabilize the system. When there is an inflationary measures, there's an inflationary measure. There's ways that the government can use to make sure they stabilize the currency. One way they normally use is to go to the BOG and what? And print more currency. When you are printing more currency, if you print more currency, are you solving inflation? I'm not sure. When there is inflation, persistent increase in the prices of goods and services, how can the government solve inflationary measures?
Government has to cut down its expenditure.
So government have to cut down its expenditure. But you see, what normally causes the inflation? What normally causes the inflation? One is the depreciation of the currency. Is that not it? When the currency is depreciating. Then the major one, apart from depreciation, is where there is a deficit budget. That means the government expenditure is more than the government revenue. The revenue the government have through taxation cannot finance what? Cannot finance the expenditure of the government. So what they will normally do is to finance a deficit budget, they will just go to the BOG and print more currency. That's what this government is doing. They'll just go to the Bank of Ghana and print more currency. Now, when you print more currency will be in the system, and production is also not increasing at the same rate. So there'll be more currency chasing fewer goods, demand and supply. Then there'll be inflation. There'll be inflation. Now, to finance a deficit budget, one thing they do again is to go and borrow. So that brings about the public debt, the government debt. There is a deficit budget. Government does not have enough revenue through taxation to finance their budget. So they will go and take a loan. They go to IMF and go and borrow. And when you borrow, you are increasing the debt stock of the country. And one thing is, when you borrow, make sure you use the money borrowed on productive activities. Use the money borrowed on the productive activities. So with the money you have borrowed, make sure you put that money in the production sector. The money should bring in something else. So increase what? Production. Or make sure there is employment. When more people are, that's expanding the tax net. When you employ more people can come to the tax net. Then you can get more tax revenue to finance your budget. But where we are, they will go and borrow, and we don't even know what the money is being used for. And the inflation will keep on rising. The inflation will keep on rising. So know the types of the fiscal policies that we have: automatic stabilizers and discretionary. Discretionary, there are two types. Contraction. So contraction, what the contraction? Is it when what the contractionary fiscal policy?
When transactional is where government reduces its expenditure, thereby reducing money available to the citizens to reduce their purchasing power.
Okay, so you reduce your expenditure by you increase revenue. Is that not it?
Yes.
You reduce the expenditure, then you increase revenue. Expansionary, you increase what? The tax, and you still increase what? You still increase revenue. Darling.
And the government.
Yeah. All right, so know about what? The fiscal policies. I want to talk about one new thing that has been introduced here. So under the Ghanaian tax system, they've introduced something new, which is new in the syllabus. Something we call tax reforms. Now, when the government wants to make tax reforms, it's like making amendments to the tax rules, to the tax principles. Making amendment to the tax rules. That's what we call tax reform. They want to change the provisions in the tax law. Okay, this section of the Income Tax Act, let's change it. This section of the Revenue Administration Act, let's change it. That's what we call tax reforms. So they can ask you about tax administration reforms in Ghana. Now, for tax reforms, there are three things they can ask you under tax reforms. And I'm saying that tax reforms is just that they want to make amendment to the tax rules, to the tax principles. So for tax reforms, there are three things they can ask you. Challenges and key tax reforms in Ghana. Challenges and key tax reforms in Ghana. And how to make tax reforms effective. Challenges and key tax reforms in Ghana and how to make tax reforms effective. Now, for the tax reforms in Ghana, the reforms should what? Should state the basic objective of tax reforms. So for every tax reform you want to do, normally the reform is about what? The tax base. The reform will normally be about the tax base. You know that the tax base is the amount at which you apply the tax rate. So normally if they are doing reforms, it's about changing the tax base. You want to change the tax base, the amount at which you apply the tax rate. You want to change the tax base. So the reforms should be what? The basic objective of tax reforms. So you should know the basic objective of tax reforms. That's what I'm telling you, that if you want to do a tax reform, basically it's about what? The tax base. Changing the tax base or giving the tax credit or granting the relief to what? To the taxpayers. If you look at it, under the Income Tax Act, the personal relief, those are not the values. The values we are using now, 1,200 for responsibility relief. Child education previously was 200 cedis. Is that not it? By now, they've increased it to 600. So reforms basically is about changing the tax base, the amount at which you apply the tax rate, or giving a relief or credit to what? To the taxpayers. So that's the basic objective of what? Of tax reforms. Then restoration of the tax base. Restoration of tax base. Then it could be on improvement of tax administration. The way the tax administration is currently, maybe we want some form of improvement in how we administer our tax practices. So you do reform to improve the tax administration or provision of incentives. Provision of incentives to what? To the taxpayers. Now, the challenges. Anytime there is a tax reform, definitely there will be logistical challenges. the tools and equipment needed to implement that particular tax reforms. There will be logistical what? Inefficiency or inadequacy of the logistical equipment for the tax administrators to implement the tax changes, the tax reforms. There'll be what? Insufficient information. The reform is just a new thing, so there's not what adequate information about the reform. When VAT was introduced, even the tax administrator, they don't even know how they are going to go about the collection of the VAT. So it will take time before the reform, the implementation of the reform will be effective. So anytime there is reform, lack of sufficient information available for implementation will be it's a challenge. It's a challenge. Then institutional policy direction. The time the reform will come into play, there will not be any proper documentation of the policy on how the implementation to be. It will take time because if you are bringing tax reforms, the taxpayers will not understand your reform immediately. It will take time. Then policy direction. Institutional structures may not be in place for immediate implementation. Institutional structures may not be in place for immediate implementation. These are challenges. Now, how do you make reforms effective? How to make reforms effective? So for tax reform to be effective, there must be clear objective. The objective for the reform should be stated clearly. There must be clear objective. There must be clear body for the implementation. Let's know who is to implement the reform. So clear body, everything must be clearly specified. Clear body for the for implementation. This one is a new thing added to the syllabus. So kindly take note. And if question will come, these are the things they'll ask you. Basic objective of tax reform. Why is tax reform done? The challenges. Then how do you make tax reform effective? These are the three things they can ask you. There should be what? Proper resource given to the body to implement what? So resources to be what? To be made available. So if you know the challenges, you can be able to suggest ways to make the reforms effective. There must be what? Responsible persons who will implement the reforms. There should be clear system of administration of the reforms. So these are how you can make a reforms effective. Like as I said, this one is a new thing added to the syllabus. It's a new thing added to the syllabus. If they ask you a question, it may be basic objective of the reform, challenges, and how to make tax reforms effective. For tax administration, I don't really want to talk about it. For tax administration, you have to know the tax identification number, uses of tax identification number, tax clearance certificate, reasons for cancellation of tax clearance certificates, and the rest. Assessment, self-assessment, and provisional assessment. Ways by which, reasons why the Commissioner General may adjust an assessment of a taxpayer. There are some reasons. Section 28, subsection 3 of the Revenue Administration Act 915, to prevent revenue leakage to the government. There are some provisions stated in section 28, subsection 3 of Act 915 that the Commissioner General can use to force you to file your returns before the due date. One is if the Commissioner General believes that you are about to cease operations in the country indefinitely, or the taxpayer is about to leave the shores of Ghana, or the taxpayer does not keep proper books of account. The Commissioner General have the power to write to you to mandate you to file your returns before the due date, because we don't want to lose that revenue. So section 28, subsection 3 of Revenue Administration Act mandate have those prevention of revenue leakages method are there. Then penalty and interest for what? For failing to pay tax on the due date. If you fail to pay tax on the due date, there are penalties that you pay. The very first day, if you fail to pay the tax, the very first day you pay penalty of 500. Apart from communication service tax. So any other tax, if you fail to pay on the due date, the penalty is the very first day, 500 cedis. And any other days that the default continues, the penalty is 10 cedis. So the very first day you fail to pay the tax, 500 cedis. So, for personal income tax, what's the date for filing of the personal income tax and the paying of the tax? For personal income tax returns, is it by the end of the following month or by the 15th day of the following month?
15th day of the following month.
Personal income tax, I'm not talking about withholding tax.
Personal income tax is filed
It's at the end of
the end of the 4th month of the following year.
the 4th month, yeah.
No, I'm not talking about the annual returns. No, I'm talking about the monthly returns.
15th.
No, monthly return is by the last day of the following month.
No, it's 15th.
Pay
15th.
is
Yes,
15th.
15th of the,
PAYE
That's
is
PAYE,
15th.
PAYE.
Okay, so which one is the last day of the following month?
That's VAT.
VAT.
Okay.
The VAT.
VAT.
He was talking about PITU. So that's why I'm confused. That's why I mentioned the fourth end of 4th month.
Oh, okay, all right.
Yes.
So you are supposed to file PAYE by the 15th day of the following month.
Yes.
And pay the tax. If you fail to do that, the very first day, that will be 16th, you will pay 500 cedis. Any other date that the default continue, you pay 10 cedis. For VAT is latest by the last working day of the following month. So if you fail to pay tax on the due date, apart from communication service tax, the very first day, 500 cedis. But what about the communication service tax? What's the penalty?
2,000.
The very first day, 2,000, right?
Yeah.
And any other days that the default continues, what's the penalty?
500.
500 cedis, yes. All right. Good. Now, let's talk about self-assessment. And for the self-assessment taxpayers, they pay tax on instrumental basis. They pay tax on the quarterly basis. So there's a way they calculate the tax that they pay on quarterly basis. What's the formula that they use? A minus B over C. Is that what the formula?
Yes.
What's the A?
That's the income.
The A is what?
The A is the tax, estimated tax.
Yes, A is the current estimated tax payable.
Current estimated tax, yeah.
The current estimated tax. So what about the B?
Tax paid.
The B is all taxes that you have paid.
Paid, yeah.
Up to the date of filing that return. So all taxes that you have paid, you take it out. The C is what?
The quarter, the periodic period.
So the number of quarters remaining, including the current quarter. Include the current quarter. So if you are filing the returns, if the tax you are calculating for the first quarter, so the estimated tax payable divided by all taxes you have paid. So that period, if you paid any withholding tax, any tax, you take it out. Then the C will be divided by 4. Second quarter will be divided by 3. Third quarter will be divided by 2. Then the last quarter will be divided by 1. So you have to know all taxes you have paid up to the date, up to that current quarter. That is what? That is the B. Now, for the self-assessment taxpayers, they are allowed to assess themselves and file their tax returns. So for them, they are allowed to revise their estimates based on the operational activities of the organization. You are there. You are the one operating. You know your operations, what is happening within the year. You know. So file your returns and pay the tax on quarterly basis. Now, at the end of the year, you have to file your annual returns by the 30th April of the following year. Now, while you file your annual returns and the estimated tax that you have filed for the year is less than the actual tax liability that you have paid, that you are supposed to pay, you pay interest at the rate of 125% of the statutory rate of the BOG rate. But there is 10% margin of error. So it is believed that allowed that, okay, definitely if you make a mistake, the margin of error should not be more than 10%. The margin of error should not be more than 10%. So you give you 10% margin of error. So your actual tax liability for the year, you find 90% of it. You compare that 90% to the estimated tax that you have filed for the year. If still your estimated tax you have filed is less than the 90% of the actual tax liability, that under estimation, you pay interest at the rate of 125% by the BOG rate. You pay interest on it. Now, there's other ones. Which other interest again? Kindly revise your note. This one, I'm just summarizing the things. So the ones that come to my mind, I will talk about them. Then we revise. All right. For a tax decision, for tax assessment decision, if you fail to file your returns, the Commissioner General can appoint somebody to prepare and file your returns on the due date. Commissioner General have the power to appoint somebody to file the returns. Now, if the Commissioner General make a tax decision on the taxpayer that you are not satisfied with the tax decisions made on you by the Commissioner General, you have the right to object the decisions of the Commissioner General. So the objection decisions are there. And for some tax types, so for VAT and excess duties, the law allow you to what? You have to pay all taxes, all outstanding taxes, plus the amount of tax in dispute before the Commissioner General will listen to your what? Your objection. So for VAT and excess duties, you have to pay. If you are owing any tax liability, you have to pay all. And even the amount of tax in dispute, you still have to pay everything before the Commissioner General will hear your objection. For any other tax type, you are allowed to pay all outstanding taxes plus 30%. Plus 30% of the amount of tax in dispute before the Commissioner General will listen to your objection. So after the Commissioner General receives your objection, the Commissioner General has up to 30 days to make a determination on your objection. So when the Commissioner General make a determination on your objection, the Commissioner General can decide to vary the tax decision, either in whole or in part, or disallow your objection based on the available information to the Commissioner General. Now, when the Commissioner General make a determination on your objection, and you are still not satisfied, you are allowed to go to the Independent Tax Appeal Board. So this, I'm telling you the objection process. After the determination, if you are not satisfied, you are still not okay with the decisions made on your objection by the Commissioner General, you still have up to a maximum of 30 days to go to what? To go to the Independent Tax Appeal Board. They will also sit and make a determination. If you are still not okay, then you can go to court. You can go to court, tell the court to make the final determinations on your objection. Now, let's take the questions I have here. Let's revise them fast. This one, by 30 minutes, we can finish them. Then we'll bring the class to an end. But before we move on with the questions, is there any doubt lingering in somebody's head? Auntie, Sister Nyamiche. Sister
Yeah.
Nyamiche, do you have any doubt? Do
Senior.
you have any doubt lingering in your mind? Or you are okay?
No, for now, no.
Okay, we thank God. This is an area that you can get some cool mark. Take note of the tax reforms. The objective of tax reforms, the challenges, and how to make tax reform effective. Take note of it.
Yes, sir. I heard you.
So, question 1. The preamble, I don't need the preamble. Present your discussion on the quality of Ghana's tax system and the enforcement tools available to the Commissioner General. So what are the qualities of Ghana tax system? What are the qualities of Ghana tax system? Hey, this one we don't know. Yes. What are the qualities of Ghana tax system?
Is it the characteristics of taxation?
Okay, give me one. Let me see if that is it.
It should
It should be. What are the qualities of a good tax system?
easy to pay.
Easy to file and pay.
So it should be simple, simplicity.
Simple.
There should be equity, there should be certainty, there should be convenience for payment, there should be economy. Then a good tax system should what? The cost of administering the tax system should not be more than the tax that will be generated. Those are the things they're asking you to write. It should be flexible, it should be productivity. So what are the enforcement tools available to the Commissioner General to prevent revenue leakage? What are the tools? So you see this question like this in exam, actually.
Anti-avoidance system.
Yes, the anti-avoidance system. Thank you, senior. That's what that. So one is what?
Arm's length transaction.
Arm's
Same
length,
capitalization,
same capitalization,
income split,
yes,
accumulated profit.
without distribution. Exactly. So you should be able to explain them. Those are the tools available to the committee. This question will be for 10 marks, not 5 marks. Look at the number of the things you'll be explaining. Taxation is often regarded as a tool for distribution of resources in economies worldwide. As a student of taxation from ICAG, critically discuss how taxation can be utilized to promote economic self-sufficiency and the industrialization of the Ghanaian tax economy. How can you use taxation to promote economic self-sufficiency? How can you use taxation to promote economic self-sufficiency?
Senior, using the progressive tax system, you can control the income distribution.
Okay. And
then when you want to also distribute resources, so areas where you want resources to go, you give them more incentives so that investment will go there more.
all right.
And areas where you want to limit, you increase the taxes so that it will deter people from investing in those areas.
All right, thank you, Senior.
So
they are just asking you to explain rule of taxation. Rule of taxation. So you can use taxation to prevent usage of some harmful products. For example, tobacco. If you know that the product will be harmful to the society, just increase the tax. People will not import again. So you can use taxation to control the usage of what? Products that are harmful to the society. Discuss two main approaches to dispute resolution between taxpayers and the Commissioner General. What are the approaches? So one is the administrative approach, and the other one is the judicial approach. So administrative approach, that's what I've just elaborated. When you are not okay with the objection, you apply to the Commissioner General. You object to the decision. Then you go through the process. Then the latter part is the court system. Then you go to court. So those are the two main approaches: the administrative approach and the judicial approach. Exclusive powers of the Commissioner General. What are the powers of the Commissioner General? There are lots of powers of the Commissioner General. What are the
He
powers
can
of
he can he can reject a certain file, then recalculate it for you to repay when he considers that whatever you have filed is wrong or something. Yeah.
Okay, thank you, Celia. You have power to levy rates, power to reject your returns, power to collect tax, power to impose tax, and all of them plenty. Explain automatic stabilizers and discretionary fiscal policy. Taxation has been described as economic, so state 5 reasons in support. So you're asking role of taxation, what we've just discussed. Party is a sole trader has not filed his returns for 2022 year of assessment. So the man have not filed his return. What steps, if any, will you take to enable the party to file its returns? So what are the steps will you take? I'm not sure. The filing of the returns date is not yet due. It's 1st April 2023. You still have up to 30th April. So just make sure he prepare his document, he prepare his tax returns and file it before the 30th April in order to avoid the penalty. What factors may give rise to an adjusted assessment by the Commissioner General? What are the factors? What are the factors that will give rise to an adjusted assessment by the Commissioner General?
When you file wrong amounts.
Okay. I spoke about this one. This one is the Section 28, subsection 3 of the Revenue Administration Act. When the commissioner realized that you're about to cease operations in Ghana, when you realize that you filed false returns or you have violated the tax principle, you realize that no, you're about to go into liquidation, your returns can be adjusted. 8 elements contained in the Commissioner General's Notice of Assessment. So when the Commissioner General make an assessment on the Commissioner General, what are the things that will be contained in the assessment? 8. What are the things that will be contained in the Notice of Assessment?
Name of the taxpayer. The amount to be paid.
The amount to be paid.
The type of
the taxpayers identification number.
The tax to be paid.
The amount of tax payable.
The deadline.
The deadline.
Where to pay.
The time for payment.
And where to pay.
When to pay. And the objection procedures. If you want to object, how to object to the decision. All those things will be in the notice of assessment. Question 3. What constitutes clearly distinguish between what constitutes tax avoidance and tax evasion, citing practical examples from the tax laws of Ghana. So we know tax avoidance, you are trying to exploit the loopholes in the tax law in order to pay the minimum amount of tax. So how is tax avoidance done? How is tax avoidance done? How is tax avoidance done?
Through the tax planning maxims.
The tax planning maxims. The tax planning maxims. That is it. Locating business in strategic area to what? In order to take advantage of the locational incentives. Taking legitimate deductions to lower your tax liabilities. Example is employing fresh graduates. Employment of fresh graduates is a legitimate deduction that you can take. You can increase your retirement savings to up to a maximum of 16.5. That is a tax planning measure. Increase your retirement benefit up to 16.5.
Increase more worthwhile donations or something like that.
Exactly. So tax evasion, that one is illegal. It's illegal. And what are the possible ways that people commit tax evasion?
Using multiple cash books.
All right, using 2 set books of accounts, one will keep the original records and one will keep the fraudulent records. Then you present the fraudulent records to the tax officials. Doing extra job for cash without declaring that money. You do the job for cash, and that one you put the money into your pocket, straightforward, down your pocket. Non-disclosure of major sources of revenue or income. Presenting false returns to the commissioner to the tax officials.
Prepare multiple financial statements.
All right. They said the Ghanaian economy has been faced with persistent fiscal deficit over the years. Measures put in place by the government to address this fiscal deficit normally result in inflation. That's what they normally do. Normally, if there is a deficit, they'll just go and print more currency. Just go to the Bank of Ghana. They don't know. Our economic messiah, I don't know what it's now doing. So you just go to the BOG and go and increase and go and print more currency. The inflation will come in. So in your opinion, what can the government of Ghana do to reverse these inflationary measures? What can they do to make sure that they reverse the inflationary measures? This one I've already answered them. One is to increase production. What can they do?
Government needs to cut down on its expenditure.
All right, so
Yeah.
they should cut down on their expenditure. The ministries are too much. They should merge some of them. And give the practical example. They should merge some of them. They should increase production. They should employ more people. When they employ more people, they will increase the tax net. Somebody said they should create balanced group. I think Senior Richard said that the areas that are not developed, they should make sure they develop those areas. They should not be pumping the money to only the developed regions. So we have 16 regions. So the ones that are not developed, they should make sure they develop them. Then when they also develop, productivity will increase, which will reduce the inflationary measures. Question C, okay, is on interest on underestimation. So this person, the estimated chargeable, is it chargeable? Yeah, the estimated chargeable income is 50 million. And the actual is 80 million. All right. The BOG rate is 25%. So you have to compute the interest. So this is chargeable income. So what you do first is calculate the tax payable on the chargeable income. So the estimated tax will be 25% of 50 million. That will give you how much? Then that one, fine. I think that will give you 20 million. 25% of 50 million will give you what?
12.5.
Okay, 12.5. Okay, 12.5 million. Then the actual tax payable, that'll be the actual tax. That'll be 25% of the 80 million. This will give you 20 million.
Yeah, 20 million.
The 20 million, find 90% of it. That will give you 18 million. So 18 million minus 12,500,000. This will give you 5,500,000. So the interest will be 125 by 25 multiplied by 5,500,000. You are good to go. Question 4. Explain 4 social rules or impact of taxation. So social rules of taxation to redistribute income, to curb the consumption of harmful products in the society, to provide social amenities. Taxation that we use to, these people now, if you ask them, they say they built public toilet. But Mia went and said that he built public toilet, the whole vice president. To curb social and environmental costs. Obligations of taxpayers. What are the obligations of taxpayers? What are the obligations of taxpayers? To register with GRA, to file tax returns, to disclose their income honestly, to present financial statements, they should keep proper books of accounts, they should pay tax on the due date. These small ones, these are the ones you use to pass the exam. Explain what constitutes tax returns. What constitutes tax returns? What constitutes tax returns?
Shows the taxable activity within a year of assessment.
All right. So it's a declaration that you make. It's a declaration that you make on your tax activity. That indicates your income and deductions due you, the relief due you, and the tax that you are supposed to pay, the tax payable for the period. Self-assessment regime and preemptive assessment regime. All right. Question 4, which is the last question. It should be question 5, right? This should be question 5, I believe so. Yes. The last question, which is question 5. So this is the last question. Then we bring the curtain down on advanced taxation. Then I can discharge you to go and justify your inclusion why you want to pass advanced taxation. You are a final level CA student who has been helping Nagote Limited, Nagode Limited on tax issues. Nagode Limited has been doing business in the international space, importing and exporting products. You have been told that when you qualify, you would manage their tax department. Charlie, this one, there's a big promise, so you have to chatter. What has baffled the company lately is an audit outcome by the Ghana Revenue Authority. The audit was done in 2 folds. One by the post-clearance audit department of the Custom Division, and the other by the Tax Audit and Quality Assurance Department of Domestic Tax Revenue Division. The audit findings are as follows. These are the audit findings. So from the post-clearance audit department of the Custom Division, import duties 10 million, VAT 12 million, health insurance levy 4 million, then get fund levy also 4 million. From the tax quality assurance department, corporate income tax 230 million. There's a VAT 29, health insurance 29, then withholding tax 105 million. The management of Nagode Limited has asked you to assess the chances of the company, if any, if an objection to the assessment is raised, as it considers the assessment quite excessive. Recommend the process that the management should adopt to ensure success in its appeal. What will be your recommendation for 10 marks? What will be the recommendation? What steps should the management adopt in order to be successful in the what? In the objection? Somebody should clear the last question for us, then we'll call it a night. What steps should the company take?
I think one of it should be that they have the receipts, the original, either the VAT receipt or the withholding tax credit.
Okay.
Senior, I'll go with it in this way.
Okay.
That they should be registered with the GRA. Make sure that they pay all these VATs. Then after they submit their receipt and other important documents to the commissioner for claims. They should, including their TIN number and their tax clearance certificate and all other documents.
Okay. Thank you very much. Who add then that I'll conclude. But you should be doing some computation here. You have to be doing some calculations here. I just made some submission earlier that if there is amount it means this amount of taxes are in dispute too. This amount of it came out from the audit that the company have not paid it, the company is owing this amount of taxes. So I made a submission earlier that before you can be successful, before the Commissioner General will listen to your objection, first VAT, VAT and excess taxes. You have to pay all of them. You have to pay the amount of tax in dispute plus any outstanding taxes before they'll listen to you. If not, they'll not listen to you. For any other taxes, you have to pay 30% of the amount of tax in dispute plus any other outstanding taxes. So this is the rule you use here. Before they can be successful in this appeal, before they can listen to them, having proper documentation and those ones is normal. But the examiner is trying to see whether if you know this rule, if you know this rule, so why you tell the examiner that for the documentation, definitely that's the conclusion you will do. I'll tell the examiner that before Nagode company can be successful in their objection, the amount of tax in dispute, the import duties, the import duties, they have to pay all. The VAT, they have to pay all the VAT. For the levies, they have to pay all these levies. So for the outcome of the post-tax clearance audit, they have to pay the total amount of tax in dispute. So you find the total. This will be 28. Okay, this will be 22. So this will be 30 million. This will be 30 million, right?
Yes.
So you add them. So in your explanation, you tell the examiner. But for them, before they can be successful, all these taxes relating to the post-clearance tax audit, then you list them. For import duty, this amount, they have to pay the total amount of tax. Now, for the quality assurance, the corporate tax, they have to pay 30% of this amount. So you do the calculation and give the 30% have to be paid. For the VAT, you have to pay all. For the health insurance levy, they have to pay all. For the withholding tax, they have to pay 30%. So you do that and get the total tax they have to pay before their objection can be listened to. That's what the examiner is just trying to ask you. I believe you are okay.
Yes.
All right. So that's how you answer this question for your maximum marks. Then apart from that, they should make sure they have documentation in place and blah, 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 blah. But the main focus is if you know that principle. For VAT and any excess or import VAT, they have to pay all taxes in dispute. For any other tax type, they have to pay 30% of the amount in dispute before they can be successful. This brings us to the end of the class. We've done 3 solid days for the intervention. Me, I was thinking I can use 2 days, but the way advanced taxation is now, the things are loaded, the things are many. So the 2 days was not enough. So you have to do 1 additional day. So kindly take your time, go through the recordings, go through the documents, whatever documents you are using to prepare yourself for the final exam. Go through them. I am available. I'm there. If you are not clear with anything, you can just send me a message or you call me. I'll respond to you. Let me take your final questions before we end the class. Any question? Senior Nathaniel, any final contribution, any final question before we close?
Oh, thank you so much. Thank you.
All right, thank you.
It's been a very long journey. Yeah,
it's not easy. It's not easy. Not easy. Advertising was not like this. Under the old syllabus, Charlie, these VATs, withholding, these VATs, personal income, those things are not there. So the thing was just simple. By now, the syllabus is well structured. You need to learn a lot of things before you can be able to make the pass mark. But these things are not anything that you can do. I'm even seeing the exam question to be, this is the first sitting under the new syllabus. So the questions won't be anything that you can do. Just study your principles, know your principles, try and remember them offhand, the principles. So if you take financial cost, what will be the principle in the normal business? If you take repairs and improvement, what's the principle? Financial cost, financial gain in the mining and minerals operation, what's the principle? What's the principle on research and development? Principle when it comes to personal encounter, what just that there are many, But you can just do a summary note. all the principles, write a short note of them. Corporate income tax, capital allowance, just know the pooling system. Repairs and improvement, 5% on the written down, just know the excess will be capitalized. Financial costs will be allowed to the extent of financial gain plus 50% of adjusted chargeable income. Write them down, simple. But take the topics one. If you come at the personal income tax, how the consolidated basic salary is computed. Then how do you get benefits in kind? All of them. Car with fuel, car without fuel, and the rest. What the rate? How do you compute loan benefits? How there are conditions whereby loan benefits can be calculated. Just write them, simple. Over time, what the tax rule over time? What the tax rule on bonus? Casual workers, temporary workers, what the tax rule? Just partnership, how do you do the treatment? All those ones, write them. So while you are revising, even if you don't read the whole book, just take that your summary notes. Okay, these are the, if you know the principle, there's no question you cannot answer. If you know the principle, there's no question you can answer. Even if the question is theory, you need the principle to answer. If the question is computation, you need the principle to answer the question. So taxation is all about principles. It's all about principles. Senior Richard, you want to make your final submission before we close?
Oh, okay, yeah. Thank you very much. I mean, the intervention is an eye opener. The first two ones.
Yes.
Yeah, so we are very grateful for your time and everything.
Thank you.
Personally, I've been disturbing you at midnight, but it's fine.
Assurance Professional Schools is also very grateful for you guys. That you guys are the main reason why we are here. If not, everybody will be sleeping by now. By now, I'll have leave my office and go and be sleeping. But I'm still in the office. Okay. So I'm around. Anything, any confusion, anything, just let me know so that we will iron them before you write. There's class I'll be doing the dawn class. You see, the day to the exam. The exam is on Wednesday, right?
Yes.
So there's some class I'm thinking about. The exam, I think this one is not afternoon.
Yeah, it's 2 to 5.
So dawn class 4 a.m. to 6 a.m. So that one, I'm just thinking, I will discuss with my brother Linus and we will see. So 4 a.m., it will be free, 4 a.m. to 6 a.m. So that done. After you learn, then we come and revise together. So I'll just come. That time maybe I may even come with some new questions. So I'll just come. This is the principle. This is how you do it. This is how you do it. This is how you do it. We revise the whole thing again within 2 hours. Then you go and write the exam to refresh your mind. I don't know if that will be okay. But I will discuss with my brother, then whatever be the case, we'll communicate on the platform.
Okay.
All right. Okay, so thank you guys very much for having me. We'll meet some other time. I wish you guys the very best in your exam and the very best in your studies. We pray that God should give us a retentive memory so that whatever we study, we'll be able to remember and give good account of our time, our stress. Our time that we are spending will not be in vain. So I wish you guys the very best in your exam. Good night to everybody.
Thank you.
All right.
Easy.
God bless you.
Thank you, sir. God bless.